did a survey earlier today of the allocators. Would you like, I want to say circa 7 to 10%, 11 to 19, or 20 plus on your portfolios? That was the question, right?
Less what you like, more what your target expectations
Right,
are.
your target, okay, like target expectations.
Well, everyone likes the 20%.
I like 20% too, but this is your aggregate portfolio, right? And the winner was in the middle. 11 and, oh, sorry, actually, wait. It was surprisingly, I thought the first show of hands was the winner. I was in the middle. But today we're mainly going to talk about the 11 and 19. And you might have something lower than that on a short duration, and that's probably could be risk reward duration appropriate. We've got a range of funds. Some are here, some are not. In private credit and lower middle market private equity that perform at the 20%. Some years net. Usually it's in the mid-teens, and I'm not saying you should skew your entire portfolio to that. I think duration has been a big issue, right, for a lot of people in the last 4 years. We showed a slide of the returns in 2021 versus 2024. Very different. Everybody's coming from a different place. Family office. Every family office. I worked for one for 10 years that was seeking 50% and got it. But that's why we didn't do 998 of the deals that we would see of 1,000. He was trying to replicate those experiences, which is magical and frustrating if you're not the principal. But some families are moving into multi-gens. They got to feed more people. Some pensions are losing money in their operating businesses. They're all different. Right? Every endowment's different. So, like private credit and short duration can fill a gap. I think we're gonna see some of this today, in corporate credit. Actually, in some of these niches, the shorter duration, and so it's an interesting grouping here. I have Josette Sheeran, I believe, will come. She's on a plane. She was the World Economic Forum vice chair. She was Condi Rice's right hand, but she's on a plane. It's hard for her to join. Coming from Austin, Suzanne we have several people. Suzanne and Dan are sick today. So Impana, Sri is going to join us. She's also joining us in Riyadh. A number of you are. And she works for a family office, a royal family office from India. We also have Mary D'Souza and Stephen Burke, who, if you don't know, be hard for you not to know unless you just don't know us. He's our anchor, Uncle Stephen, we call him. He, every Tuesday, like yesterday, tells us what's happening, and the world kicks off a conversation. So 11 o'clock in the morning on Tuesdays, you're all welcome. It's our community gathering. So if I could ask Stephen and Mary and Impana to come up to kick off our how we see the world, what scares and excites us, maybe share an insight or two that we're not thinking about. We will kick off. You'll see that this is a very interactive discussion, so if you're new to us, it's not going to be they're talking and we listen. This will turn very quickly to you asking questions and sharing insight. It's going to feel as if a round table, which again, some of you don't know us, so let me just do 60 more seconds on 360. So 360, actually let's go to the one firm. The one firm comes from Arthur Andersen. Who remembers Arthur Andersen? 1, 2, 3, 4. All right. If I ask I have a third grader, a 10th grader, and a sophomore in college. I don't even think my sophomore in college knows what Arthur Andersen is. But it was the greatest firm, in my opinion. I was a partner, and I was working in Europe, Russia of all places. And but I worked in Korea, around the world. No one said, is that a U.S. project or is that a corporate finance project? No, it was an Arthur Andersen project. We all came together. We are one P&L. And that philosophy, and then living abroad, because I think what there are a lot of great family office groups, but do they host in Riyadh? Are they hosting in Mumbai? We want to connect everyone around the world. You know, you might be looking at private credit, you might be looking at whatever the asset class, or company, right? Russia's a great example. It was easy to be in the internet in Russia. You just copied Yandex or list.ru. Hotmail was trying to remember, mail.ru, right? There's so many things you see the Uber coming, and then it's happening in Singapore, it's happening in Jakarta. So that's sort of what we can do as a global group, is we can see these things happening and share, and kind of arbitrage or whatever. The 360 is I'm from Ohio. I'm from a small town, blue collar town, not too far from Intel is building its plant. And some of you have been there. I was there this past weekend. Ohio is definitely coming back, but I didn't know anybody in New York. And I came here in 2004. I knew more people in London. So I went to my alumni. I went to Michigan and Denison. And I was underwhelmed by the alumni events. So I had to create my own, where everybody, I wanted the antithesis of what I was experiencing. No inefficiencies, everyone introduced themselves, and if we had more time, sometimes we've even done that. We did it this morning. And we're going to do that with our roundtables later today. So it's a 360, is getting everybody together in roundtables. So with all that said, what we do is we raise capital. So a lot of these people here are funds or companies that we raise capital for. Usually we take 20% of the management fee and the carry, so we're in for the long haul. Sometimes people protect their carry with everything, but we'll just take a couple points, fine. But we're usually in for the long haul along the way. And if we raise money for a company, we usually take less in cash and take warrants. We want to be aligned with them. We don't have to. I don't really raise any. I show Mary some things from time to time. You're new, and Stephen. A lot of what we're doing is just educating each other, and along the way. Although, we created a 361 Ohio Tech Fund with Stephen.
Which I'm an investor.
Yeah, exactly. So we some things will just happen organically. So anyway, that's us. With that, I want to turn it over. Stephen wants to go last.
Ladies first.
No, actually, Steve's first.
And I need to get my notes.
You can set it up.
I'm going to let Mary. You're really good at this anyway. So I'm going to let you. How do you see the world? What scares and excites you on April 2nd?
You want me to introduce myself?
Both. Yes.
So, hi, I'm Mary D'Souza. It's great to see all of you. Mark, thank you for inviting me. I run a single-family office, Nisha Investments. We invest both in public as well as private. Public probably 60%, private about 30 to 40%.
Can you look closer to the microphone?
This is like the perfect time to talk about diversification, because if you're solely in the public markets for the last month or two, you'd have felt a lot of hurt. You'd be in a world of hurt. So I really think as family offices, we have to be very diversified. We have to have both public as well as private. And on the private side, I really like private credit, because the way I look at it is, where can I get a certain amount of certainty, right? And if you have managers who can really analyze credits and also have operational expertise, because if you look in the last 10, 15 years, we've had the financial crisis, we've had COVID, we've had interest rates going up, and if managers don't know how to deal with all of that, you could lose a lot of principal. So you have to look for credit underwriting and experience across several cycles. I also like real estate. And for more alpha, I usually look for managers who are really good at VC and growth equity.
I can go. Hello everyone, my name is Ifana Sri. I'm a Chief Investment Officer at a family office called Coherent Inc. I like to think I sit at the intersection of engineering and finance. And I do work with a family office in India, the Royal Family Office, Jaisalmer, to help with them on their impact-related investments and initiatives. I will touch on a few topics in terms of things that I'm seeing, just given who I am. One biggest thing is the India-US changes that I'm seeing. I moved to the US about 10 years ago, and I had not looked back at India for a while. What I can say is India has no longer been the same. It hasn't been the same in the past 5 years alone. Growing up, like I had my own startup in India. I went to engineering. I was a woman. There were societal and traditional and all sorts of constraints that just affected us. But it has changed in the past 5 years alone. It has made me feel that, oh my God, did I come searching for gold while sitting on a diamond mine? Both are good. All treasures are good. But what I'm seeing right now is India is no longer becoming a tactical growth play for funds, for LPs. It's no longer a cost arbitrage market. It's becoming something that's purely fundamental, that it's almost you need to have it. But why that excites me, like especially in the consumer space, there's a prominent family called Ambani's that democratized access to internet, and that has changed the landscape completely. People have now access to more content, more knowledge, and they're building companies, and women are being empowered. I'm surprised, and men are coming in support of that. It's wider than the Wild West, as I like to say. I think it's becoming the Electric East, almost. While there is such a strong interest in this space, I also ask that you proceed with caution. Identify trusted advisors, trusted players. That also scares me. Another thing that also excites me, just given the spaces that I play in consumer, is such a huge market right now. I'm seeing US brands wanting to enter the Indian market, whether be it in consumer, in the tech infrastructure, you name it. I'm seeing family offices getting institutionalized more and more. Startups having insane returns, and some of the funds that I've worked with, while they've invested in consumer, they're seeing 35% IRR.
So what scares you?
Just finding the right partners in the Indian market. It's really, really tough finding trusted partners. I think there's a cultural difference that you have to be mindful of. How things are conducted, how culture plays into making deals while you're talking to different heads of the family, different members of the family, the timing of when you do certain deals. I know this sounds strange, but people refuse to do any deals before the new moon, or it's very important. I'm not saying it's there's certain scientific reasons that they don't do it, but when you show that you understand their culture, understand how to talk to someone, you talk to different heads in a different way, different people in a different way, it really, really makes, it goes a long way. And building trust with the right people, finding the right partners is what scares me. I've heard so many scary stories of a deal not going through, so trust is everything.
Segue from that.
Yeah, I did make this mistake the last time because I went after Zoe Cruz the last time, and that didn't work out very well for me either. So pleasure to be on the panel with these two amazing ladies. I just say quickly, there's, to me, 5 big changes that are going on that impact asset allocation and should impact the way we're thinking, both short-term and intermediate term. One is, for all the hopes, I don't expect peace to break out anytime soon anywhere in the world. Geopolitics is not getting any better, and the globalization and fragmentations could make relations worse, not better. And unfortunately, I think the U.S. is taking the lead on the latest round of disruption there, disorder. I think on trade, we're actually seeing that changing terms of trade, which will be played out later today in ways that we'll know over the next couple months, hopefully. It doesn't drag on too long, because if it drags on long, inflationary pressures go up greatly around that. I think from fiscal policy, we're seeing some big changes. The U.S. going to austerity, while Germany, China, Germany and Europe stimulating, China stimulating for stability. I think Germany and Europe are stimulating to deal with the problems created by the U.S. and China, and their own making inside Europe, because they've made a lot of mistakes there. I think monetary policy has become much more two-sided. Everyone was looking at rates going down, continuing to go down, and big rate cuts from the Fed and the ECB. I think it's going to be much more challenging right now with tariffs to see that come to light. So I think those are a couple of the main ones. And I think generally we're seeing massive post-World War II institutions coming under pressure, again, driven by the U.S. primarily, and that creates some challenges for how we move forward. So I think what scares me are three things. I'm not as confident in global leadership as I would like for the challenges that are being presented today. The second thing that scares me is global debt and the ability to manage that debt, particularly given the economic problems the world is facing. And the third thing, and I think this is a newer one, and it's created some major concerns around the world, is people questioning commitments to the rule of law by governments in the West, or from democratic governments, and how that plays out. And then lastly, I'll just close. What excites me is, with all that negative stuff, the world continues to evolve in amazing ways that we can't imagine. With AI and other areas, the ability to improve productivity and to change people's lives is all in front of us. So that's where I'll stop, Mark.
All right, where's my microphone?
So,
There it is. Okay, we're here to talk about private credit and private debt, private equity. So just on that, so I know you like it, Mary.
It's my background.
Right, you like what you know. Just tell us what you think, how you see the markets shaping up, how you think we should be thinking about participating relative to other asset classes.
So, as you know, I worked at GE Capital, and GE Capital was a middle market shop, where we did both lower middle market as well as middle market deals. And I think on the private credit side, it's so important to have operational expertise, to really do your due diligence, to have governance, to make sure that it's structured right, so that when things go wrong, you have a place at the table and you can work out the credit. So it's really, really important to find the right managers, right? And for me, I have, working at GE, I knew most of the managers in private credit. I'm invested in Star Mountain Capital. I've known Brett since 2009. And I started out with Fund 2, investing with them. I'm also a strategic portfolio partner over there. And I look at various managers who are a little bit smaller, because it's not about asset gathering. Because when you're looking at asset gathering, it's all about doing as many deals as possible and doing large size deals, because your funds get bigger and bigger. So whether it's private credit or private equity, or whether it's investing in venture capital or growth equity, for me, managers are really, very important, and I do a lot of due diligence on them. And I want to see interests aligned, to see if they share with the rest of the employees, because if it's just the senior partners making a lot of money, you don't get the same alignment of interest. So there's a lot of things that go when you select a manager, whether it's in private credit or other asset classes.
Okay.
I would say, I think we learned, if you saw the slides in the earlier session, and Bill Deukler did a presentation where he looked at the range of returns from the top quartile to the bottom in private equity. It was, I think, a 30% gap. reinforcing your need for strong due diligence that both you ladies represented, because I think the other change that we really have to come to grips with is we're not going back to zero interest rates anytime soon. And if we do, it's going to create there's a whole other level of problems we want to worry about. But I think the ability to produce returns at 4% are going to be a lot different than were at zero. And I think that means much more caution and due diligence and better asset allocation strategies across the board. I also think that the benefit of private credit is you do have the liquidity options that aren't available in other privates. So I think that's a big change, because I think liquidity matters more today than it has at really any point in time in the last 15 years.
Yeah. In terms of some of the areas that
The microphone.
in terms of some of the areas that my company is looking to invest or is investing, while AI has been great, we're trying to look at companies that are more developing AI solutions that are more tailored to enterprise companies that can work with their other existing platforms and other existing technologies. We are also seeing AI chip market increase as well, and companies that are more aligned with that space is what we're interested in, whether it be TVs, larger PCs, so on and so forth. So that's some of the things that we're seeing in the private market where we're looking to invest.
So questions, thoughts from everyone?
I wanted to add one more thing
Sure.
to India. So I was at an AGM of one of the funds I invested in India in Bangalore like 2 weeks ago. And what was really interesting is you talked about consumer, right? So they invested in Bluestone jewelry. So when I first saw the investment, I was like, oh my God, am I going to get my money back, right? And there was an up round, and they took some of the money off the table at 3x. And I'm like, none of my other funds have given me that kind of return. And the interesting thing about India funds today is the companies start in India, but then most of their revenues come from Europe and the US, because especially if it's a software company or a cybersecurity company or an AI company, they start over there, but they become like global companies. So.
Yeah, I agree 100%.
Microphone.
I agree 100%. In terms of consumer, there's a lot of people want to spend, but they don't know where to spend. So these companies that are starting out now are, benefiting a lot. The one thing that I've noticed is like patterns, right? That's really what I'm really good at. And I grew up in like 14 different parts of the world. India I see now is very reminiscent of 80s and 90s US. We got our first Apple store 2-3 years ago. I cannot believe that. Like, I couldn't believe that. So think of whatever was happening in the US at 80s and 90s and try to replicate those similar investing strategies in India right now. That's what I would say.
Yeah, question?
Mary, you brought up doing due diligence on funds you invest in, and for anyone, especially in this room, it's clear how institutions have teams and processes and do all that. But from a single family office perspective, how do you approach doing due diligence?
Yeah, so I'm a little lucky because I worked at GE, and so I got to see a lot of deals, but I also got to see a lot of private equity sponsors, as well as private credit guys, as well as hedge funds. And because I was on the sell side, I also got to see what kind of diligence they did when they invested in my deals. So I have a lot of institutional knowledge about each and every manager. And so as a single family office person, it's a little easier for me than most other single family offices to invest.
Sorry, I'm taking a video here.
What you do?
How would I do
The due diligence.
for
As a single family
As a single
office.
family office.
I have someone on Zoom that wants to.
Yeah.
I want to. Parth, do you mind? Because you're developing something that what you call the India-U.S. corridor. I'll pin you so people can hear you, meet you. You're in Texas at the moment, though.
Sorry, Mark, I didn't hear all that. Would you mind repeating it?
Yeah, so it's, let me get you on here. 1 second. What you're developing in India, because we're talking about, it seems to be a theme here so far, kicking it off. We're going to talk about private credit and equity, but we're talking about India. Go ahead.
Right. So I'm Parth Akil. Nice to meet everyone here. And you know, the family background is you know, had a chemicals business in India, and my focus has been really developing a more formal family office structure around it. You know, we've invested both in the U.S. and in India, and what I'm doing right now, what we're looking to build is essentially a platform for cross-border allocations, right, between the two markets. And I think, you know, to some of the points that were made on this panel, the investment landscape is just drastically different in the two markets, right? And the way you would vet and select managers, especially I would say in the equities space and public markets, varies drastically. And, you know, really sifting through what was kind of data-driven and what was some of the fluff that may have driven performance in Indian markets is something that we've been paying a lot of attention to, right? And I think is very hard to do sitting here in the US, and requires extensive on-the-ground knowledge and folks there. Now, with that said, I think that the growth story is getting to a point where it's extremely compelling for people, especially in the US. But how do you actually play India is something that we've been solving for a while. We think we have a decent handle on, and we're looking to, yeah.
And you're sort of a co-host mobilizer of our Mumbai event in October. So this will be a continuing theme, but it's now 2 o'clock, 2:01. I got to switch gears to the India panel, but that's okay. Thank you for that. We'll keep.
Thank you, Mark.
We'll keep this thread going in different ways. So first, thank you, everyone. We're going to move on. So Dixon, Morgan, Crandall, if you could come up, and Ilya, if you could come on. I don't know if you could come on camera. Ilya Gertzberg definitely knows his way around the landscape of private credit. In fact, he's an investor in Star Mountain. Where he's also was our sort of co-host of what we did together. There he is. I'll spotlight him for you. He's in Monaco at the moment. There he is. And we did a private credit event during COVID, right? And now here we are. So this is your panel, Ilya. I'm gonna, even though you're sitting not with us, but you are. So I'll let you lead it.
Thanks, Mark. Yeah, it was a real pleasure doing the first private credit summit with you 4 years ago. During COVID, you can say that it was an entirely online event, and it's great to see your network grow by so much. I've been based here in Monaco for almost 10 years now. As a CIO of a single family office, my mandate there was to generate highly defensive returns, and private credit was the way to do it. We were shooting for just slightly above market returns while being senior. And the way we achieve that is by doing co-investments with selected GPs, while also investing rather small tickets as LPs, and also entering into various side letters, SMAs, and such. We ended up doing close to 50 deals over the span of 6 years. Only 2 of them were mass, the rest of them were senior. And our preference is the US, followed by Asia, and only then comes Europe, given that the cost of capital in Europe has always been lower. It was great getting to know many managers in the process. I actually left the family office end of last year, and I'm currently a senior advisor to one of the GPs, and considering my next move as a family office allocator. In general, I would look at the world of private credit as follows. 70% of it are really large funds doing large, predominantly sponsored deals. And these are the, these deals were never hugely attractive to begin with in terms of returns. The covenants have been rather loose. And there's obviously a lot of competition in the space as well. And at the same time, these are the firms that have the marketing budget. They have really established names, and whenever you go to conferences, chances are that you'll be hearing from these funds the most. And 30% is the rest. And these are the funds that are offering often differentiated strategies. So with that, I'm very pleased to present our panel for corporate credit, all of which are the funds that are generating alpha. They are not operating in the mainstream, and they have a lot to share. So why don't we start with Mountain Capital?
Sure.
You could put
So what do you wanna do? You want
Crandall, you could put the mic to your
Sure.
closer.
Yeah, we can just do the round of introductions.
No, the round of introductions. Sure, awesome. So Crandall Dairy, Star Mountain Capital, managing director. Been there about 3 years. I work on both the investment team doing direct investments, as well as on the capital markets team, bringing in all the counterparties into our deal, whether they're senior, imperial, or behind us. I've been doing this about 20 years, starting in 2004 with Mary over at GE Capital. Then went through a joint venture with an investment bank and an insurance company, publicly listed BDC, and then an SBIC fund. So I've seen it in a number of different flavors, fund structures, and really settled in at Star Mountain because of the focus on the lower middle market, but bringing scale to that equation, which a lot of others have not been able to do.
How's it going, Morgan Jones?
Thanks, Brendel. And
Sorry.
I should also mention that I've done at least a dozen of deals with Star Mountain as a co-investor, and was also an LP in one of their funds.
How many deals?
So next on
They've
is,
only done 200. I know the bio. How many deals? Joking. Sorry. Go ahead, Morgan.
Hey, how's it going? Morgan Jones, co-founder of Wilmore Capital. We're a private credit fund focused specifically on the revenue-based funding sector, which is really more of a royalty-like security versus a loan. Focus on the small and mid-business sector. My business partner, Bill Airy, sitting in the room today. He runs one of the highest volume small business lending brokerages in the U.S., and my background's in private equity, private infrastructure investing, so worked at Digital Bridge Partners Group, and do some consulting for Monroe Capital. Nice to meet everybody.
Great. Our third GP, Dan Fruman, unfortunately got the flu, and so he's not joining the panel. So I guess but we have Dixon, who represents the buy side, I guess.
Exactly. I'm Dixon Hayes. I'm with the single family office. I've been sort of in the family office world for about 15 years. Previously was on the hedge fund side. And so we have a pretty broad mandate in that we invest in managers, and we invest in direct deals on our own, and we co-invest with managers. So we sort of look for folks who we can partner with repeatedly, and sort of build real kind of long-term relationship with, and really kind of focus on smaller niche areas. We don't want the broad generalist necessarily. We build sort of a portfolio of sort of sector or specific expertises, and kind of consolidate that into a larger portfolio.
Great. So just as a way for everyone to better understand what you do on a daily basis, perhaps each one of you could describe a recent deal or a typical deal. What does it look like for you?
Sure, I'll kick it off here, but I'll say, more than often than not, we're the first institutional capital into the company. We're frequently partnering with experienced operating teams. That includes the owner or the founder, and we typically have an equity partner, whether that be a funded sponsor, an independent sponsor, or rollover equity from the former owner. Our structures always start with senior secured term loans, but we frequently have equity upside in the form of structured preferred. Our companies are 100% US based. They're all private, between $5 and $50 million of EBITDA. We're generally industry agnostic. We focus on high free cash flow generating businesses, predictable revenue, and defensible market positions. Examples include business services, critical infrastructure, healthcare. What we don't do is real estate. We don't do commodity linked industries like oil and gas, and we don't do gray markets like crypto or cannabis. Most common use of our capital is for growth or for acquisitions.
Thanks. Yeah, so like I mentioned before, most of our focus is in the small and mid-sized businesses. So we earlier today when we were pitching, 80% of small business loans applications get declined by traditional banks. So our fund is filling the gap to support these small and mid-sized businesses throughout the U.S. Typical use cases for that the small businesses use our money for is, let's say they win a big purchase order, need to buy inventory, we'll pay down our facility with the fulfilling of that purchase order. Or let's say they're bridging to a larger permanent capital markets event, whether they're raising debt or equity, that could take anywhere from 3, 6+ months to close. We can provide them that bridge financing to get them from point A to point B. Or let's say they want to acquire a competitor. Like I mentioned before, our product is not a loan. We're actually purchasing a percentage of a company's revenue at a discounted rate. So let's say a company comes to you and says, we're looking for $1 million. We say, okay, we'll purchase $1.3 million of your future revenue, and that's repaid on a daily or weekly basis over a 3 to 12 month term. So high velocity of cash flow compounding and principal recovery, as well as very short terms, which provides us a lot of agility to pivot towards industries that are experiencing tailwinds and away from industries facing headwinds.
We don't really have typical deals. As a single family office, we're sort of investing all over the place, and usually we'll partner with managers who know those spaces better than we do. But when we do go direct, we've sort of found an interesting niche where we partner with venture and growth equity sponsors, and we'll come in on the private credit side as sort of that bridge capital, or if they're looking for $5 or $10 million, so they're not going to go for kind of a large institutional manager. So we'll sort of leverage the relationships we have with the equity sponsors and come in and just be that flexible capital where, frankly, those companies are really starving for funding, and especially less time to do funding.
That's a smart strategy. Plus, you got the capital coming in with you underneath
So the
you.
next question goes to the heart of your role as a capital allocator. How capitalized is your niche, so to speak? What's your fundraising outlook if you're a fund? And what would you do differently if you had 10 times the amount of capital that you have now?
We'll start out again on this one. on this one, but we believe the lower middle market, it's underserved. The banks have largely pivoted, although they haven't left the space, they just approach it at a different angle, and they're really as much partners now as they are competitors, whether they're coming into our deals, revolver lenders, first out term, whether they're up in our fund level leverage facilities, whether they're LPs in our funds. And so they've really kind of pivoted within this space, right? But our strategy is somewhat consistent here on what we're trying to do. We're trying to be a capital solution provider, value-added partner to the lower middle market, right? We believe that offers the best risk-adjusted returns. And so what we've been doing on this is usually what happens in this end of the market is people raise capital and they end up losing out market because the leverage, the labor is not scalable. It takes as much labor to do smaller deals as it does a bigger deal. We're trying to crack that code, whether they be more efficient people and processes, systems, and invest in heavily in that or early in that, you know, whether it be really a data architecture, building out new processes, AI, on top of stuff. But the process is pretty straightforward in there. The focus is always on that. The fundraising environment is improving. It's a little bit choked up, as you know, just given the non-distributions that got back to LPs. And then start to restart a little bit here, but the focus is on the market. One right now.
Yeah, so I would say we're a very niche asset class within the private credit space. As of 2023, I believe the total market size is about $23 billion, expected to move up to $44 billion by the end of 2031. There's a lot of players in the space. There's institutional capital, both on the investor side as well as the lender side, facilitating these transactions and backing the funding companies that are offering this product. I would say from a capital raising perspective, I think where we differentiate is one, diversification. We are going to have exposures to about 300 to 500 underlying RBS across business models, industries, geographies, etc. Obviously all within the U.S. The repayment frequency is daily or weekly versus a traditional loan where you have payments every month and it's a 3 to 7 year term, or terms of 3 to 12 months, repay daily. And we can offer 14 to 16% annual yields, 17 to 22% net IRRs, which is definitely alpha relative to some of the other private credit funds out there. If I had 10 times the capital I did today, I mean, I'm just executing the same playbook. Focus on diversification, looking at concentration risk, making sure that we have proper exposure to the right industries that are going to be doing well now and in the future, and we have the ability, like I said earlier, to switch and very very quickly pivot, just given the short-term nature of our funds.
This question probably isn't down my alley. We're all internal capital, so we're not fundraising, which I'm thankful for, and I feel for all of you who are fundraising. It's hard. Yeah, so probably we can go to the next one.
But Dixon, if you were managing a lot more capital than you do now, and that's a dilemma for billion-dollar family offices, what would you do differently?
It is, and in some ways having sort of this defined capital base can make it a little bit easier because we can sort of stick to the to certain types of strategies and sizing. Because if we were 10 times bigger, I would say we'd have to be really owning and operating multiple businesses, and we're not equipped to do that yet, really. And so it would be a totally reimagined investment strategy, because the deals that we do tend to be a little bit nichier and smaller, and so we can scale them by doing more of them, but then we get into a little bit of adverse selection, and I'm not as interested in going kind of up market in terms of deal size. So so I actually sort of like where we are. You know, having 10 times more capital, I guess we figured out, but probably dilutes the returns a little bit.
Yeah. Randall, which metrics are you monitoring on a quarterly or perhaps even monthly basis. Where are they trending, if they are in fact trending? And does that give you any crystal ball into the state of certain industries, or maybe even the economy as a whole?
Yeah, so I'd say we're pretty active managers of our portfolio companies. We get monthly reporting, we sit on all the boards. I probably talk to these guys at least once a week, whether it's the CFO, the CEO, or the head of sales. So we've got pretty good visibility. As far as the general KPIs, we're always looking at revenue, gross margin, EBITDA trends, what the liquidity is, what the coverage ratios are, what the macro industry trends are. And then across every portfolio company, we're going across the big three right now, which is tariffs, immigration, and government spending. But as far as companies, the specific portfolio companies, we do have very specific KPIs associated with the operating metrics for each portfolio company that we track on a performance basis. We also track them where they are and what we call getting middle market ready. So as we're institutionalizing these businesses, where they've done it, they've got their finance function in order, they have the right person in the sales function, where they deal with their ERP system. All those types of things that we track to get them up and get them ready to exit into the middle market where the multiples are higher. So we definitely stay on top of that. As far as the crystal ball is concerned, through year end, I think we were pretty good. Obviously, there's been a lot of turbulence. We have a contract in the portfolio, so obviously we're working through that. That's been pretty interesting. On the insight side, we've got like Brent Carson's on one of our boards, and so we get pretty good intel on what the discussions are with the government. I think the answer to that is no one's really knows, right? There's a lot of repositioning and all that spending. There's a lot of turbulence that we're trying to work through in some of those portfolio companies on that side. But outside of that, I'd say we've been in a pretty good position. I think there's a lack of some of the decision making right now has been paused. Just because people don't have the conviction. I don't know what they're doing. There's some of the other guys that are really going on offense, and this is a time where they can be busy and there's some competitive weeks. So just out of the portfolio company, last week out in LA, rental, obviously fires impacted that business, but it also impacted their competitors. And my view is like, let's go play offense in that environment. We should be able to pick out some of their best salespeople and various other stuff. So those guys could not as well capitalize or equip to manage through that process where our group ships, right? We're looking for opportunities to play offense selectively. But as far as taking on risk, we just closed one in the behavioral space, an autism platform. We're looking to bring on some actually some co-investors on that space. And so working through things there like Medicaid risk, right? And people trying to get their hands around that. It's obviously different than other parts of Medicaid, but there's a headline risk there. And so you got to sell through some of that stuff as well. But that's the general thought that we're feeling so far.
Yeah, so our primary focus is on the revenue growth and revenue consistency of our companies, and just given the daily and weekly repayment schedule, we're the first person to know if that business is running into trouble or their revenue is decreasing, running into issues, and you can immediately execute a workout plan to try to kind of help them either extend the term, lower their payments, and if that doesn't work out, obviously you can go into more legal action for breaching contracts, UCC things, etc. So our focus is primarily on the revenue piece. We're an emerging manager. We're in the capital raising mode now. Haven't started deploying yet, but a lot of the deals that we're seeing across the industry is consistent from industry perspective. So construction's a big one, retail, healthcare. Some of the industries that we're seeing pullbacks on is real estate and transportation. So we just monitor the macroeconomic factors. Obviously, tariffs. The tariffs is top of mind for a lot of folks. So in the event that, we hear something different every day, but in the event that there's more confirmation on which industries are going to be affected, which industries are not, we can focus our capital deployment on the industries, so U.S. manufacturing that has U.S.-based inputs, U.S. customers, or industries that have inelastic demand characteristics, such as healthcare, food production, energy utilities, etc. So we have, we just keep a pulse on the overall market and kind of act accordingly.
Yeah, I would say on our end, we tend to favor the more defensive sectors, especially on the private credit side, not surprisingly. With the folks that we lend directly to, we are in constant contact with them. We want to have a very kind of open and transparent dialogue. We're here to help, we're not here to take over their business. And we really sort of build the portfolio more from the bottoms up, really looking for good individual opportunities, whether that's a direct or a manager. And so we pay attention to the macro data, but we don't have sort of a slew of macro economists, so we just try to, not make dumb mistakes and try to be defensive. Again, we're sort of, families created their wealth, and so we're trying to preserve and grow that. We're not really trying to look to take kind of undue risk to make a little extra cash.
Well, thank you for this macro insight. But more generally, what keeps you up at night?
I'll go with that. Sort of answers everything on that one. But it doesn't literally wake up in the middle of the night and think about those guys all the time. But I mean, I'd say it comes down to three main things. Do I have the right people in the right seats? Do we have liquidity? Are we getting accurate and timely information? I feel like if I get those three things together, I can massive but I think those are the three main things that when I think about this stuff, I'm looking, who are my guys in seats? Who's sitting on the board? Who are the operators of this business? And do I trust them? Do I think they do what these guys have sufficient liquidity to execute on their plans? And are they getting time to catch up?
Yeah, so I think both the RBF market as well as our fund is pretty well insulated from a lot of the common things that keep you up at night, just from a diversification and recovery standpoint. One of the things that is kind of top of mind that is again uncertain is the new administration potentially rolling back regulations on the banks, which might create additional competition in our space because the space has really taken off because the banks stopped lending to SMBs. But with that, we'll still be able to compete on timing to execute timing of the fund. A traditional bank could take, like I said, 2 to 4 months, maybe longer from initial evaluation to funding. Our deals close in as little as 24 to 48 hours. And that's by leveraging technology to look at underwriting, look at 3 to 6 months of prior bank statements, come up with annualized revenues, and it's purely focused on that. And then there's a human element of an underwriting team and principal call, due diligence call to get further confirmation that it's a good credit story.
I'll offer sort of a slight spin on Crandall's answer, which I really liked, but I actually sleep pretty well because I've picked a bunch of good partners. And I think that is, kind of echoing your point, is the most important thing, just really doing business with folks that you can trust, that you can rely on. They're going to make mistakes. We're going to make mistakes for sure. But then we're looking at it in the right long-term perspective and that our interests are aligned. And so I think that, again, I'm comfortable with that. I'm happy with that. There's all sorts of macroeconomic noise and events that, frankly, we have no control over. So try not to focus on.
So just I had a question on that. What are three qualities that you look for in the partnerships and the collaboration? And from the first meeting, as far as like what's your due diligence on them? What's your process like?
Yeah, it's a good question. It is not a kind of uniform diligence process.
Can you go closer to the mic?
Yeah, so a lot of the time we meet our partners through kind of trusted intermediaries, friends, other family offices. So that personal recommendation carries a lot of weight. That's not the be all end all by any stretch. But a lot of the time we will we'll start doing work with partners. Maybe we'll shadow a deal that they're working on, and then the next one maybe we'll invest directly into that deal, so it's a co-investment. And then,
recording in progress.
After we do what we would look to invest as a LP in their fund. And so that allows us to get to know them, get to see how they work, really kind of get to peer under the hood. It allows us to underwrite the deal and the manager. And so you could have a really good manager in an unattractive deal, or you could have a really great deal despite having kind of a manager that we're not that impressed with. Not a lot of managers are sort of, that's probably not their preferred way of going about it. They'd rather just have a check as an LP. But I do think, especially with the more specialized niche managers, they're much more open to that. And that's also just sort of candidly a sign for us that they're willing to work with us. They view this as a long-term partnership as opposed to, I'm just trying to get this, these dollars into this fund and then I'll worry about the next one later.
Yeah, I mean, I'll answer it from the people that we're investing in, meaning the companies and the operators and the owners and all that stuff angle, not the people that we're partnering with on the capital side. But it's a really interesting question. I think that's the area that we're really trying to figure out how do we underwrite that better. It's probably one of the harder things to underwrite. I feel like we can get into an industry and get down to the drivers and all that stuff pretty quick, right? If we've done enough deals and all that stuff. When you're looking at people, how do you underwrite people, right? And we're really starting to build that out. And we're getting down to where are these guys located? How often do they meet? Like, what's their family situation? Like, stuff that you're not even supposed to really ask, but, you kind of get into what are the motivations?
Crandall, earlier today, one of the managers said they wanted their founders to be connected with the Apple Health apps.
Yeah, I mean, but seriously, like, there's stuff like that. I mean, so I work with a founder. Like, we're a founder-owned company. We're 100% employee-owned, and we're very similar to the people that we're investing in, right? And I can point to that. And that's like, this guy loves running Ironmans, and he thinks everybody should be running Ironmans. I'm like, I don't know if I can put that on the thing, but there's stuff like that. Like, how driven are they? What's their personality type? We've got like 3 different tests that we can run on that, right? Will it be the trimetric or this or that, right? Mm-hmm. And it's not necessarily just qualifier. It's how do you communicate with them? How do they communicate with other people? How are they building a team, right? And I've got 3 portfolio companies I'm working on right now that are all performing. That are all, there's something going on with the relationships that I'm having to manage to make sure that these things stay on the rails, right? And it's just silly little things, right? But it's important, right? And I've got, because I've got founders that have been in this. It's a sausage maker, right? The guy doesn't know corporate finance. He can't understand what some of the stuff that's
Crandall, I'm sorry, we're past our mark, but I think we get to just, you guys do a lot of due diligence. Ilya, you want a final word before we move to the next panel?
I'll let the esteemed panelists have the final word, which is a very general question, and you may have addressed it in many ways as well. But how do you create this cycle agnostic strategy where you deliver consistent returns even in a somewhat volatile year like this?
That's not a final word. I think you have to boil it down to like a sentence. Because we have to move on, but I know you probably got a paragraph, but
I got a lot, yeah.
What's the most important?
Structure. We stick on structure, right? We're senior secured. We don't go over levered, and we get good reporting information. We don't try to time the market. We just stay with resilient companies and put on good structures.
Gotcha.
Yeah, I would say diversification is our key risk mitigating and ability to maintain stable returns on correlated to the markets, and we have the agility to pivot.
Cool.
Yeah, for us, I think it's just not getting over our skis, so kind of sticking with things that we know, with people that we know and that we trust, and not getting greedy when other people are, and maybe when people are a little afraid, then we'll put on a little bit of extra risk.
Okay. And Ilya, your final word?
It's great to see managers consistently reinventing themselves and always looking for perfection.
Sounds good. May that be our mantra for today. Okay, well, thank you. Next panel, if Jeff and May and Gerard could come up. I know, Rich, you're online, but you can chime in if and when you can. We're going to talk about real estate, similar but different. So it'll be the same question, general question. What scares and excites you in real estate? And I sort of know Jeff's thoughts, but maybe Gerard, I'll start with you because I have no idea what you're going to say exactly. I like that.
Okay, thanks very much. My name's Gerard Getz, single family office, principal based here in New York. What scares me?
Speak to the microphone.
Hello?
Yep.
Okay, what scares me? Bad operators. I mean, there's a lot of them in the real estate space. I think a lot of them got washed.
To be fair, I didn't let you introduce yourself.
Okay.
That might help the context, like of where you're coming from. Sorry, but if you could pause on that if you could.
Yeah, sure. I'm a single family office principal based here in New York. My background is public markets and then more private markets the last 10 years. So in the real estate space, where I've been investing last few years, mobile homes, industrial last mile, and multifamily. Some things that are scary to watch out for is risks, I guess, is just like any investment, your sponsor, their track record, their confidence. Obviously, low rates, anyone could make money for a long time. This market is more challenging, but you can definitely make money in this market, even if you're buying stuff over the last few years, if you underwrote it correctly. So, you know, the operator, the sponsor, their story, their competitive edge. I think the scary other things are insurance is out of control everywhere. Obviously the worst in the coastal states, but it's a problem everywhere, and operating costs are just up in general, and there's inflation. Other scary things, I'm not a super fan of like Class A. I'm usually investing in stuff that I would never want to live in, but the supply demand is better for those assets. There's obviously been a ton of development, which is now getting delivered. You know, last year, this year, next year, it's going to weigh on the top end of the market. Got to be careful of that. What am I excited? And now, what do I like? Is that the second part of the question?
Yep.
Look, values are probably down 20%, 25%, depending on where you look, and you know, there's interesting stuff to do. In terms of what I'm seeing and where I've been transacting is like there's a few things. One is distressed stuff is lender takebacks, and you have something that you can buy for the value of the debt, and it's really cheap. It's one opportunity. There's going to be more of that in the next couple of years. I think the other opportunity is just small balance stuff like $2 to $15 million equity checks, and and not super levered. So LTVs of like 50 to 60% in mobile home and industrial outdoor storage. I think there's opportunities to get yield on cost north of 8% in those spaces, and I think that's pretty attractive.
Gerard, you're actually saying what excites you again. But what really scares you?
Oh, it's all that what scares me?
Yeah.
Yeah. Well, I listed so I'll go.
I'm joking. Okay, let's keep it going. May, you wanna? I know you wear a couple hats. How do you see the world today?
Well, I guess I'll just start with a quick
Please.
introduction.
Please.
I'm at a single family office, and I've been investing in real estate on behalf of our family for the past 10 years. What scares me, kind of keeps me up at night now, is it seems like in the past 6 months, a lot of brokers in the city and kind of in the country have been pushing aggressively office buildings, and it seems to be this strange coordinated effort. and it seems to be a little bit more out of desperation than genuine good opportunity. And if you kind of look a little bit more into it, it appears that about $2 trillion in commercial real estate loans is coming up to maturity in 2025 up to 2027. So I think this is actually quite risky considering a lot of these loans are also held by regional banks. And I think with some of the problems we've seen in the past few years with First Republic and a lot of liquidity issues, I think this could really become a bigger issue. I want to see kind of how it plays out in the next year. So that's kind of what scares me with just a lot of, I think, liquidity issues with a lot of the loans happening now.
Do you know the geographic dispersion of the $2 trillion?
That's in America. Yeah, so I
But-
think about 1.2 trillion of it is actually up for maturity in 2025, and the remaining 2026 and 2027.
But inside America, do you know the general breakdown?
I think also office recovery has been different in a lot of different places. In New York, it's been completely fine in Class A. They've been getting rates higher, I think, than ever. And then Class B and Class C has suffered quite a bit. But New York City has more office real estate than a lot of metropolis have, even real estate in general. So like we have so much vacant real estate and vacant office real estate in New York, more than some other cities even have office real estate available. So I would say a lot of majority of it is in the Northeast.
All right, tease you up, Jeff.
Jeff Keith, Fairbridge Asset Management. We're a real estate private credit fund, bridge lending, which I spoke on earlier. My background is I spent 20 plus years in leverage finance on the street, flipped to the buy side, and found real estate. I would say risks, rates and tariff uncertainty is a common theme. More importantly is real estate's local. It's never, that's the adage we use. You can have a down market in the Smile States right now, Las Vegas, parts of the Southeast, but the other areas are doing really well, Midwest and the Northeast, especially Ohio. And the reason the Northeast we like...
You love Ohio.
I love Ohio. And the Northeast, which, they let a lot of tax abatements expire during COVID, which then there was no building. And so you basically have a shortage of housing, not only across the country, but also in the Northeast. So we still like the Northeast. Fannie and Freddie Mac have just come out with numbers, and it's anywhere from 2 to 7 million of shortage of housing. And that's really rental units. George, you touched on, we are in the Class B space. It's not where some of us would live, but it's workforce housing, and that space tends to be a little bit more recession resistant. Finally, we really value the sponsor. When we walk into a developer, we sit down and ask them what their 1, 3, and 5-year business plan is. We don't want to just do one loan. We want to work with borrowers over the next 3 or 5 years. And those borrowers, we actually ask the due diligence as well. Who's on your team? Do you have an infrastructure in place? 65% of our loans right now are with repeat borrowers. And you can really don't miss on valuation in real estate. You can, with all the metrics out there, you can get within 5%. What we value when we look back at our defaulted loans, it's all on execution. It's, we like to work with borrowers who have been through COVID, been through rate rises, been through cost overruns, supply chain issues. Building's not linear. There are going to be some bumps in the road. So we want to work with lenders who have been through that process. So that's a risk. So we go out and visit we just hired somebody 6 months ago to go visit all of our sites rotating to make sure, keep a pulse of our developers and figure out where they need help. And I would say underwriting is really critical. We brought an institutional approach. The founder of our firm also ran a family office, sat in that seat that many of you did, sat at an asset manager, and we have credit memos that are 30 pages long. We have weekly credit meetings, weekly asset management meetings. We have an underwriting team. We have a desk of analysts. So you want to bring that approach to your firm and try to due diligence everything you can.
Well, I have another general question, but anybody can ask a question. My general question was, I told the panel, share an insight that you don't think we're focused on, that we should know about. But I know there are a lot, what, the great thing about real estate is everyone's here is in it, right? So you all have if you have an insight, you know, what scares and excites you, chime in. But is there something that you think, sometimes we call them fun facts or interesting facts, but just something that you think we should know about? I'm looking at you, yes. Right, Jared.
I don't know if it's like a secret or what, but I just think cycles don't matter as much when you look for real inefficiencies. And when I'm trying to invest in this space, I'm looking for like sellers that are selling for non-economic reasons, either family succession things or just other forced.
So how do you access that? How do you find that?
You just have to keep searching and like networking and wait around the hoop for things to happen.
I mean, like around the funeral homes or something? What hoops are you hanging around?
No, just a lot of this stuff is held for a long time and by families, and some of the stuff, especially the smaller transaction sizes, like under 20 million, they haven't been efficient in managing the asset. And when the patriarch wants to pass it down, and maybe there's a problem with dividing it and they just need to sell it, or it gets passed down, they want to sell it, there's just an opportunity to reprice, especially some of these, like inflation was so rampant in the last 3 or 4 years, you really had to adjust rents 30% or you were, dropping rents on a real basis. And some people didn't raise rents. So that's an opportunity. You can still find stuff like that out there.
I'll come back to how you're finding it, but how about, who wants to take the next, this general theme, an insight or fun fact?
Well, I think a lot of people put a lot of focus on the real estate interest cycle, but we kind of put a lot more focus on loan maturity cycles, especially since in 2018, a lot of these loans were underwritten at 3%, 4%, and now they're coming up for refinance, and they're refinancing. They have to refinance at 7 or 8. I think a lot of these are going to become distressed, especially if you combine with the fact that in some cities, like in Arizona, in Texas, in Philadelphia, rents haven't increased, they've actually decreased, and the pro formas were written at 3 to 5% rent increase over time, and that hasn't happened for some of the cities. So I think you're in a situation where there could be forced liquidity calls from the bank, and I think that's a good position for like single family office investors to really get, I guess, a good bang for your buck. So that's something I'm looking more into, just when loan cycles mature.
Sure. Jeff?
I would say, having worked in high yield and looking at all fixed income products, I don't think I've ever seen a product in the bridge lending space, in the middle market, where you have consistent returns, not just us, but there's 8 or 9 fund managers out there in the bridge lending space that we really like. The returns might be lower, and I think you can get consistent returns. I think insights people don't realize in this middle market space that we get first lien personal guarantees on these loans that were first mortgage. On the capital raise side,
but your there's some of you get caught up. There's some of your peers go over their skis, and
like I said, there's some quality bridge lending managers. We get asked all the time. We like you. Who are 3 other funds you like? And we're very collegial, and we recommend funds that we compete against. I think another insight on the capital raise side is a lot of the independent RIAs, the sort of 2 to 20 billion world, which is where we focus on, they don't have access to fund managers, and they like the alternative investment space. And we're seeing a huge transformation in the alternative investment space. We're seeing fintech companies pop up to help handle that subscription process. to invest in it all. The RIA world, the independent retail investor, has been sort of pushed, has been kept out of that, and they want to create more alpha in their portfolios. So we're seeing interval funds, startup, fund of funds. We're seeing feeder funds inside of $2 billion RIAs who then put 10 managers in it because they don't want to have an exposure to it.
I thought one of those RIAs was on the Zoom, but he's not on right now. Or I don't see you, Rich. But I agree with you. We love RIAs.
So the capital raise space is taking on new paradigm shift.
All right, let's open it up. Questions, comments? 1 second.
Please.
Well, she was on a panel already, so.
Hi, my name is Horant. Nice to see you all, and thank you, Mark, for hosting this event. I think this is a really insightful event. This was my first that I attended personally, and thank you everybody else for attending. So the elephant in the room, which nobody has touched, at least at the conferences I've gone to, is especially in relation to real estate, and I'm in real estate, is government, regulations, bureaucracy, and I don't know if you'd call court system, but unfortunately, whether you like it or not, I'm involved in the court system indirectly, and nobody has brought that up. And when Mark said, what keeps you up at night? Well, first of all, nothing keeps me up at night. Thank God, I'm doing very well. But my concerns would be, let's say, as far as the system, as far as bureaucracy, getting worse and worse. So could you just elaborate?
Jeff did. Thank you. Jeff said that's why he's in Ohio, partly because he can get his money back in 60 days.
Right.
If you
Did mention that, right?
Yeah, I mean, I don't want to take too much time, but just really quickly, when we look at a loan, we price out what state it's in. Is it judicial, non-judicial? And if it does go through foreclosure, how long is it going to take for us to get our money back? We do that on every single credit memo. So luckily we have 3 lawyers in-house that know bankruptcy and foreclosure laws. They're different in that state. So we do look at it.
I would say when it comes to bureaucracy, a lot of that is, especially in real estate, hyper-localized. So depending on which county, your relationship with the city council and the Department of Buildings in that city, it changes drastically. So I think that's why sometimes it's very good to specialize your portfolio instead of diversifying, because then you can really bank and build stronger relationships in the county and potentially do private-public partnerships and have that work in your favor instead of against you. So I think that's why one of the reasons we like to specialize in certain geographic regions.
So I had a quick question.
Go ahead.
How much of distress are you guys seeing in the marketplace?
I think Macy's distress coming.
I think another interesting about, I guess, distress loans, kind of to your point earlier, some of the best ones are kind of pre-distress or at the bank level. So you have good relationships with regional banks. You kind of get first dibs before they kind of go fully distress. The ones that you see public distress or going to auction or foreclosure are generally, yeah, those that hasn't quite happened yet on a large scale. I think with what I was saying earlier with the long cycles maturing, we might see more of that, but I think currently it's still very stable. But I think there is some pre-foreclosure action happening on the regional bank level.
So 1 second, Bill. Since you were on the panel, where you spoke earlier. Glenn.
Well, I think Gerard, you were going to say something.
Okay, yeah, Gerard, go ahead.
No, I was just going to add to that. I think that's right. I think what I'm seeing is there's stuff distressed. Everyone knows it's distressed. It's, new people want to take over and certain people have to in with the lender and they're just talking to them for like 6 months and the lender's trying to, do the right thing and kick the can. There's been a ton of that. There's going to be more, but eventually the lender's just like, this is hopeless and they'll just sell it for the value of the loan, but it's either a deed in lieu, so it's not gonna hit the court, or it hits the court for like a day, but there's a buyer, so there's not a lot of stuff just like, out there in the ether distress. It's kind of being cleaned up immediately, aside from office, which is just, its own disastrous animal.
Thank you.
Hi, Glenn Veronic. Thanks for all the great information on the panel. Really appreciate that. I'm in real estate as well, and my question relates to it seems that more and more, given the capital markets more generally, we're seeing an eye towards liquidity. And are you seeing in the private equity side for real estate any interesting structures or creative structures that maybe deal with the liquidity question at the get-go?
I'll start. I mean, I think there's been like some innovation, but I wouldn't call it great. I think you see some of the active retail targeted syndicators like creating REITs and trying to give people liquidity, and there's like valuation, based around that.
If you don't have anybody else, go on.
I don't know, like, if I was involved in stuff going into that, like, where I was getting appraised, I'm not, but it's not a great situation, but I'm not seeing anything really new beyond that I call out.
We just, if that answers your question, we just did a co-invest deal, and what you're seeing is a loan that needs to be financed.
Use the microphone.
A loan that needs to be financed, and you tranche that loan into 3 tranches. You can do an A note, a B1, and a B2. So it's a waterfall, and you're starting to see some of that out there in the sort of the restructuring side of the market, the co-invest side.
Bill's got maybe.
I feel like I maybe haven't been around long enough to have anything to compare to. I don't have much to add.
So it doesn't sound like any of you are.
That's okay.
I just was wondering if you guys have been able to secure any solutions to speed up the process using new technologies that are coming out, in particular with the underwriting part. Do you require appraisals to be done or environmental phase 1, phase 2 stuff?
I would say with appraisals and kind of environmental, this normally done by like an entity or a government-like entity. So in those spaces, no. But I would say with AI, it has helped a lot of the operations or even due diligence and some of the perform on the math behind it. But appraisals and in that space, no, it's more of an appraisal agency. They have the best power.
Totally.
We are seeing the value on the valuation side.
I text everybody.
Also, we are using AI on the due diligence side. We're also talking to a couple of providers to make, how do we streamline our underwriting process using AI. We were just talking to the gentleman in the audience about that. So we're definitely trying to keep up on technology, on the underwriting, on the origination.
I'm using AI quite a bit for just due diligence purposes, just speeds everything along, kind of uncover negative information that is obviously not being disclosed by someone marketing something too.
I assume the entire room is hopefully using AI. Any other questions? This is real estate. Any segments that you guys are excited about? Of course, if you're so excited you don't want to share it, maybe. But.
One second. So it doesn't sound like any of you are specialists here, but you all look at real estate. We keep hearing, we heard it 3 times today. I hear it all over the place. Housing shortage, housing shortage, housing shortage, okay? And so I don't know if Fairbridge does like construction loans or anything like that. Yeah, you do, okay. So if there's such a housing shortage, then other than the 20 huge public home builders, which are easy to see, I don't see a lot of real estate people in our sort of circles that are doing anything more than maybe a multifamily or something like that. It's not, nobody's like trying to jump on this opportunity. Is there a reason why not?
Well, maybe you're not in Ohio or the South.
There's 49 other states.
Yeah.
No,
Anybody want to speak to that?
Am I missing something?
Well, you sort of touched on it. Who wants to speak to
We have
it?
a bunch of service guys still on those buildings,
Oh, because you're doing HVAC roll-ups?
They're all pivoting out of multifamily and all into residential and industrial, for whatever reason, in different regions of the country. So I've got them in the DC market, in Arizona, the Southeast. I got them in Ohio, in Columbus, beautiful town. And yeah, no, all of them without fail in all the regions are pivoting out of multifamily for whatever reason.
Okay, Jeff?
I would just echo real estate local. So just because you're seeing no construction in some areas.
Consolidated numbers, but they come from somewhere.
Yeah, well, it's Fannie and Freddie, and there's a shortage of, let's pick the middle, of 4 million, and that rental units. So rental units is very different than.
I know, I said both.
Yeah.
Single family, for the end. Anyway.
I will say, I think in a lot of cities it's actually an oversupply, right? In Philadelphia or Arizona or Texas, where they build a lot with a lot of incentives over the past years, rents have actually decreased in a lot of these places. So I think, yeah, to your point, it's definitely very localized, depends on where there is a housing shortage to really, I guess, address your question. But in a lot of places that we've seen a lot of activity in the past 5-10 years, just don't have a housing shortage.
Yeah, one thing to add is New Jersey is the second growth market in the country in terms of real estate right now. Believe it or not, because the 5 boroughs, because all of that building didn't get done for 3 years. You have police officers, firemen.
Not Connecticut?
Moving to Paterson, New Jersey, and commuting into the city.
So I like that. I'm from Columbus, and I live in Short Hills, and Millburn, and Summit, and these places can't make enough housing.
On the market.
I'm telling you, they're building.
My daughter and son-in-law bid on 7 houses, couldn't get one. The house next to me sold in 4 days over asking.
Okay. Well, look, I'm going to keep us on time. 3 o'clock. Next, you're the. Notice the applause for the on time. Thank you. You're moderating the next panel. So it's public fixed income, structured credit. Another way to play this. So.
Can I get my ridiculous slide so I don't have to talk about it?
Nadav, do you have the ridiculous slide? You can find my email.
While everybody's.
So introduce your panel as we get your ridiculous slide up.
Anthony, I'm going to stand here so I can see this and this.
All right.
Otherwise, I can't see anybody. Anthony. Sit here. Anywhere. Lane's online, so it's just you guys and Simon's on.
He wants you close.
It's just you two here.
Apparently.
Yeah. Right here. Unless you, Herman, you can sit way down there if you want.
All right.
Okay, structured products. So that'll come up. I took a ridiculously complicated slide and reduced it to an overly complicated slide, so I could spend 2 minutes and not talk about it for the next 43, because we're not teaching you how to build a structured product. Okay.
So Sumit's going to take 60 seconds to get that ridiculous slide.
It's all right, no worries.
And otherwise introduce.
We still have people here. So I'm going to let everybody introduce themselves, but I just want to point out that we have sort of roles on our panel that kind of cover all bases. Let me start online. Do we have Ling and Simon?
Ling?
Ling? She told me she dialed in. So.
She's in.
So just
Ling
get her
Lu.
up there.
I'll get her on.
There she is.
Hi, I'll get you here. 1 second.
So I'm going to let everybody introduce themselves, but I just want to point something out because we have this sort of balanced panel here. So
There she is.
Ling is on the rates desk at State Street Bank. Okay, she doesn't do structured products, but if I get the diagram, I'm going to point out why that's very relevant to the conversation. Okay, Herman. More recently departed allocator to hedge funds, and hedge funds are big players in structured products. Okay, so an investor. Okay, Anthony runs a fund, a hedge fund. You want to call it a hedge fund? Not a hedge fund? I don't know. It's up to him. Doesn't matter. Hedge fund's not a thing anyway. It's just a fee structure. So his structured products. I have a diagram. But he does it very differently than the diagram, except he's playing in the same sandbox. So we're going to let him talk about it. So when we get to that, okay? What I don't want to do is get super down in the weeds because we're not going to be here for 3 hours.
Start with Ling.
And yeah, so let me let everybody introduce themselves first. And maybe we'll have this gobbledygook on the screen. Anthony, go first.
Yeah, thank you very much. I'm Anthony Dweek. I'm a portfolio manager with Anchor Investment. We run portfolios of structured corporate credit, and we take pretty default risk on portfolios of 80 to 100 corporates, typically looking to generate meaty returns.
Herman?
So I recently, as Andrew mentioned, I left a fund-to-fund called Titan Advisors about a year and a half ago to start my own business, helping hedge funds raise capital, but also working with some of the large multi-strats like Millennium and so forth to secure senior portfolio managers, which is the hardest thing for them to do these days.
Yeah, a lot of competition. Ling?
I run the global rate strategy for the investment portfolio for State Street, about 100 billion portfolio, mostly global rates and mortgages. So my team look after global rates, focus a lot on obviously the Fed, the US rates market, Eurozone and Sterling, as well as Australia and Canada. So has always been interesting the last few years, so Trump is making it even more interesting. Happy to be here, thank you.
And to Ling's point, we're not talking about junk bonds. We're not talking about, these are all kinds. They are floating rate, in some ways secured loans. And you'll see, if we ever go, there's a list, okay? So, because people play in slightly different areas, but all the securitizations that are worth talking about at least are that. They're not super low grade, distressed, nothing of the sort, okay, to do that. So, okay.
Which medium and which email did you use?
I sent it to your WhatsApp, and I sent it
there we
to
go. Okay.
Mark Sanner at 361.
All right, I'll find it.
Okay. So, me, it's my 40th year investing. I spent 20 years in a captive group of Swiss family offices. 5 years trading commodities, stocks, options, futures, basically anything that moved. The families invested in the hedge fund lifted me out, and I ran a hedge fund and 3 venture capital funds for them. Venture capital, and I was a tech guy and investing in Dell a year out of the garage and kept getting tech deals. So we did very well at that. 2003, the family office groups broke up. I had they wouldn't even let me bring Americans, but for venture, we had American investors. But anyway, so I left that, and it's just a coincidence, but I went to State Street. And I was a guy that didn't wear suits, no title, no nothing, never heard of me. And so they needed somebody like that because they were starting a fund of hedge funds, and they didn't know anything about it. And I had a plan that I'd worked on for our family office group, and they said, just come do it here. So I basically built, designed, and ran for 13 years State Street's global fund of hedge funds. It was very successful from many points of view. And it was run very differently than an institution because you had a guy who had never been in one. But they let me do my thing. And it's like having a startup with State Street Bank's footprint. Ling's in an office tower in Canary Wharf that says State Street on it. So it was kind of a really interesting situation. So I hired 140 hedge funds and all over the world, and in every asset class. And then didn't want to be in it. We sold my group to InvestCorp. So I spent 2 years there. And when I left in 2017, because I'm coming full circle with this, 9.5% of the portfolio was CLO, triple B, double B derivatives, which is part of what comes out of structured products. So that was 9 years ago. Full circle to today, one of our family office projects is working with a hedge fund, the existing credit hedge fund. They want to be in the structured product business. So we're putting the equity portion together to help them launch their They're already well established, but they want to add that on. So full circle, I'm actually doing all this kind of stuff today. So my point is that there might be questions that I might be the one answering them if somebody else isn't more appropriate to that. So with that said, okay, so we'll get back to that in a minute. So let's start with a couple of things from the sort of investor side. Because you got two guys. You have somebody that would invest in him and somebody that runs it. So and Lynn's not specifically involved in structured products. So we'll get to that in a second. So Herman, from a perspective of an investor, and we had very diverse portfolios. We can invest in anything, right? So because he recently we knew each other from the same business. So what is the attraction? Just from an investor point of view, what's the attraction of structured products in general?
So when you think about...
And these mics are not loud, so you have to kind of step.
So when you think about securitization, you can tranche it into different tranches, right? For about AAA, AA's, all the way down.
Let me stop you for 1 second. I want to take 2 minutes, and then if there's questions at the end, it's fine. I'm going to take 2 minutes so maybe everybody knows what they're talking about. Okay? So you can kind of draw a line down the middle. These are all the assets. They're all loans. Senior loans, middle market loans, mortgages. Remember the mortgage crisis? Securitizations. But also other stuff, student loans, whatever, there. Okay? So you want to create one. You need the equity. That's what I'm talking about. Project Now. You build something called a warehouse, which is basically a big pile of all these assets. And then a bank, and there are different grades, and it's a process. And then the bank securitizes it into these notes. So you're buying assets here, and you're selling notes over here. So the AAA is and these are insurance companies and foreign banks and pensions, very low risk, very low return. Why would an insurance company do it? Because they're in the insurance business. They're writing policies, and the regulators want very safe asset. So they buy this stuff. We wouldn't want it, I can tell you. So then you get down to the sort of safer but higher return somewhere in the middle. And as I said, you got, small BBB, BB, got hedge funds in here. And then the equity part, which is what I was also discussing, is private equity and the managers themselves. The specialist funds, wealth managers off-take it, and private investors like us. So you got these two sides. Here's the structured product on the right, and here's all the assets on the left. You got borrowers like United Airlines and Chobani, Uber. They're not people you never heard of. These are public companies. And then the underwriters these are all big banks you heard of. And then the manager builds a warehouse and goes and cherry picks. They do a lot of fundamental analysis, and they build a portfolio that's appropriate. And it's well, there's huge institutions, there's hedge funds, and then there's boutiques, but they're trying to build an optimized portfolio. So to securitize. So that's that. And unless there's questions later, I'm not talking about it. So anyway, so Herman, back to the attraction.
Got it.
And by the way, this I pulled this from a CLO thing and tried to take it out. It doesn't matter. You securitize any of these assets, the process is the same.
All right, Herman. Herman, you're going to go now.
Except for Anthony. Go ahead. That's the end of my speech.
Andrew actually has me beat in tenure in this business, but I've been in the business for 35 years. And I actually started.
By the way, Eddie, he went to Leiden.
Ja, hey Eddie, leuk om je weer te zien. Zeker een keertje
Ja.
voetballen.
All I know is lekker.
Heel lekker. So as you can tell, I'm Dutch. I graduated from med school in the Netherlands, and then I actually started in mergers and acquisitions at Salomon Brothers. So I've been in the business 35 years, and then I switched to government bond trading here in New York, and I sat 5 feet away from the mortgage department. So I know a lot of the people that you probably read about in Liar's Poker, and many of them are actually my friends. But the point is that I've seen markets evolve over time, and back in the late 80s, when you talk about securitized products, it was basically residential mortgages that were backed by Fannie or Freddie, or the underlying collateral were Freddie Mac and Fannie Mae mortgages. Obviously today, there are Dunkin' Donuts, anything where there's a cash flow, you can securitize it. In other words, you take those cash flows and you carve them up into different credit tranches.
So someone that wants a safe tranche, they'll buy the AAA tranche, and then it goes all the way down to single Bs, and then you have the equity piece, which is like the nuclear component, which can blow up at any point in time, but the returns can be pretty substantial. I mean, it's
So
it's
wait,
true, right? Yeah,
so ending with the word blow up, Anthony, I'm not gonna put you next. Ling.
But the point, to
Yeah.
answer your question, what, you know.
By the way, these are very
What's attractive is you can pick and choose the level of risk that you can take. And when we're talking about AAA, when you do stress testing on some of these tranches, you know, you'll stress test it for long-term capital, stress test it for the global financial crisis, for COVID, and you can see that these tranches barely move in some cases. And that gives people a lot of comfort. And some of the yields on this can be, you know, fairly substantial over and above the risk-free rate, whether it's 10-year treasuries or whatever.
By the way, no AAA or single A has ever defaulted in the history of the business. But you get down, but it's certainly, it's not as risky as I think you pointed out to me. We'll get to Anthony in a second.
The equity piece.
So, no, even the equity piece, anyway, we'll get to that. Ling, so what is your point of view on all of these assets, that are in front of you, and the stuff you look at and matters to you, and the stuff, of course, that's just a derivative of what you look at?
Obviously, I'm no expert on structured credit, but I've been to a couple of crises, the subprime crisis. There are some senior AAA tranches marked down substantially. So the market volatility is definitely out there. Obviously, a lot of them eventually is money good. But I remember those times when you say money good from 100 to 82, it's a tough sell. But anyway, we've got lots of experts here. But I think this really stressed the fundamental analysis. At the end of the day, as Andy, you said, securitization is a process or a way of making a sausage in one way or another. But what goes into the ingredients, which is the SSI, which is the fundamental analysis, is really, really important. In a great macro environment, supportive central bank, stable policy, political or global trade environment, you probably get a lot less volatility, and then you're going to have that steady return. But I think we're actually not in those environment anymore. So I think for each of the sector, first of all, I'll talk about my own sector, which it used to be central bank running the show for years. We were doing QE. It's quite predictable, but it's also very boring. In fact, that almost killed the macro hedge fund industry for over a decade. But what has happened after COVID is the rate environment has changed substantially with the inflation. Obviously, I don't have to rehash what happened in the last couple of years. But it makes the market more interesting. You see a lot more divergence of central bank policy, economic backdrop between Europe and US. We talked a lot about US exceptionalism last few years. Really, that story is still on up until only a few months ago. So a lot is supported by, very supportive, central bank policy, as well as the fiscal support during COVID, as well, very strong consumer, as of now. But I think the real changes over the last few months, literally, the uncertainty of the trade tariff discussion. We're going to have very interesting information coming out in the next few hours. And I'm pretty sure that it's not going to be the end of it. I think it will be the start of a lot of uncertainty. So that means the fundamental analysis you have to do in terms of all these trade policy, and then correspondingly the reaction function to what the US does, for example, the fiscal spending in Europe, all that would have huge implication to not just the central bank, but also reaction function, the rate paths, which is very important to all these asset classes, but also the industry, like wood industry, maybe the defense industry, that, benefit from some of the tremendous expense in the expansion in Europe. Just a few examples. So
Ling, do you mind?
A lot of
Ling, do you mind?
Impact. So I think from that point of view, to look at the each sector, and then to look at the various factors, how they impact different sectors, that it would eventually affect the spreads of the different sectors.
Ling,
Over time, time.
We'll talk about that.
Ling, I have a question for you real quick. Can you just let everyone know, because I'm impressed by it at least, like what you manage?
What's your day job?
We have a pretty large custodian business already. The State Street has a lot of that. It's one of the big custodians.
I mean,
so we manage the.
I remember
SSI
19 billion.
Sheet, invest mostly in government bonds, swaps, interest rate position for the bank.
I just wanted everyone to know
we have about 70 billion exposure, but mostly through central, my team look across all the central banks, what they do, the five major one, which we have the largest deposit, and then, what's the impact of that, and also the monetary, fiscal, political environment, and what's the impact of the economy as well as inflation. So what does that mean to the
Ling,
the longer end of the curve?
Ling, when I was there, I worked in asset management. She works in corporate, so we didn't have the same jobs. But I was everybody's collaborative, even it's a big place. So I know that at the time, maybe it's less so now, the balance sheet did have things like senior secured loans and some derivatives and some of the fixed income funds. And I know you're not in asset management, but do you follow that everything you talked about, the collateral effects on any of these? These are all floating rate instruments. Do you follow the relationship at all between them?
I used to work at SSGA up until 7 years ago, and I moved the bank side, so I know the SMN side of the business as well. But you are absolutely right. The investment portfolio used to be a predominant floating rate structured book, actually, of almost like 90%, up until I would say kind of 2016, 17. But then because the CCAR, which is stress capital requirements from the Fed, State Street as one of the GSIP, one of the systematic important. So we actually shift the book mostly almost the other way around, 80% structured, 20% kind of rates product to 80% rates mortgages, rates global rates and plus US mortgages to
today?
20% structured product. Just the nature of the bank treasury book.
From 2016 to today, Ling?
I feel that, I feel from my
There's a delay
next to the head of credit, and they look at structured credit very closely, and it is closely related to the macro environment within that economy. If they look at Aussie, ABS or RMBS, it's a very different dynamic from, let's say, from Eurozone or the UK buy-to-let, sector. So I think the fundamental from a macro perspective and the specific fundamental analysis from the assets and the pool and the structure is very different, for example, from the ABS market in the US.
So just a last quick statement. What you were referring to was a change from 2016 to today? Is that what you were just saying?
Yeah, I think actually even more so because there is a lot of the structures, are from some of the aftermath of the subprime crisis, and we kind of, that also along with the regulation change, it just, not just State Street, but almost all the US bank book has become a lot more HQLA, just high quality liquid asset class, which means US mortgages and treasuries and stuff.
I was there beginning through the crisis and after. No, so I wanted to have Ling talk more first, because this is the background against the other conversations, right? So she's sort of setting the stage for the asset classes and what you look at and the risks and that type of thing. So I cut Herman off when the thing came up on here. So we were just talking about, and you were just starting to talk about the advantages of investing in this type of thing, about being able to control where your risk and returns were. You just expand on it a little bit before we move to Anthony.
Yeah, no, of course. The securitized products market is around 14 trillion, if you include RMBS, CMBS, ABS, and you compare that to the treasury market, which is like 28 billion, so roughly double the size.
There were 1.4 trillion in CLOs issued last year.
So the market is large. What that means for managers like like yours.
Well, he's
like
a
your
special.
fund.
He's a specialist manager. He's not these.
What that means
yeah.
is that there's a lot of fish in the sea. There are a lot of sectors that you can look at, and if you're good and you're sector specialists, you can pick up bonds that are potentially undervalued, that are being mispriced. Actually, I'll give you a quick anecdote. My wife actually works in securitized products at Barclays. My daughter actually works at JP Morgan on the securitized products syndicate desk. So I sort of live this stuff.
So we got the wrong part of the family here.
It's sort of in the family. But the point is, when you think about edge and you think about technology, and someone asks a question about are you using AI are you adopting AI in terms of your process? You know, as an allocator, I was always looking for a manager that seemingly had some edge, right? So for example, I'll give you an anecdote. My son currently is doing some programming for this company called Neural Labs, which basically what they do is they do risk assessment for insurance companies, so flood and fire and things of that nature. And so he's doing this, the software that he's developing is looking at residential, real estate, CMBS, commercial, across the country. And he's doing this image adoption where you can see the type of roof, the type of bricks, what the backyard looks like. It's super cool stuff. But what it means is, you know, my wife was talking about one of her clients that were looking at this bond, and it was trading at like 70 cents on the dollar. Meanwhile, they were talking about California, the floods, the fires, and what happens is when you get fire, the clay, the ground turns into clay, it gets really hard, and the water flows over, and you get floods, and it just precipitates more and more damage along the way. So what they were doing is they were basically throwing out all these zip codes in California because they were in California. Meanwhile, the company my son was working for was looking at a lot of these zip codes, and a lot of it was green. In other words, those properties were actually perfectly good. So the map that they're looking at was mostly green in these certain zip codes. What that means is if you're a manager and you have this type of technology and you have this edge where you can look at some of these bonds, and if they're trading 70 cents on the dollar, but you think there's going to be no defaults there because the properties are perfectly fine, that's edge, right? You could pick up potentially 20, 30 cents on the dollar on these bonds. So it's things like that that we look for as allocators and managers.
And this is in the corporate world. Reinsurance is specialty finance. By the way, it wasn't on the other panel, but it's one of the categories.
But take shit to Anthony, because that's
so
the edge.
No, I haven't left him out.
But you
have
have 5 minutes left, so I'm just trying to give him his due.
So Anthony if you take this, he's playing in the same sandbox, but you can throw out my diagram. Am I correct? And one thing he's not paying me, when he put his chart up and the recovery values were 0 and 50, and you're talking about people, the recovery values are 50 to 85% on average. So don't put 0 on your chart. Anyway, go ahead. So Anthony, explain how you've taken a different approach to accomplishing sort of the same thing, please.
Yeah, thank you. So we at Ankara, we manage the equity tranche. So the key focus obviously is to avoid that tranche going nuclear.
As are we. So go ahead.
Yeah, no, for sure.
I'm knee deep in it.
But we have quite a lot of flexibility and levers that allow us to do that. But by virtue of holding the equity, we have full control of the portfolio and the structure. So we decide, obviously, we do all the credit selection, and we deal in corporate credits. So to put numbers behind that, the universe is probably about 600 credits that we can choose from, and we need to have about 100 in our portfolio. So there's a lot to choose from, and that means that we can choose across the credit spectrum if we wanted to. If we wanted to be really risky, we go single deal, double B, or we go to double A if we want it to be secure. But typically we swim in the triple B and double B space. And that's proven to be very resilient to market stress.
That's investment grade, by the way.
Yeah, sorry. And then the other key, I guess, lever is that we can decide on the terms, and by terms we decide on the maturity, for example.
You can dial it in.
Yes, exactly. So in time of uncertainty, like probably today, we try to go shorter maturity. And maybe at peak, what we feel is peak default cycle will go for longer maturities simply to get more convexity to our product. And it's something that has worked out well for us. You know, between Accra and Spadessa, that's 15 years of history. You know, there's never been one of our equity tranches that has lost money. It's always been very ours. And that's going through the financial crisis, the sovereign crisis,
08
COVID,
pandemic.
Yes.
Yeah.
You set up that slide. And I think it's down to, it's because of our market, which is a bit peculiar. We can play with all those levers.
But you're playing with the top two assets on my asset list. You're still playing with those assets.
Yes.
Those are senior secured loans.
No, it's not. It would be.
Except you're playing with it a different. Go ahead. You explain.
It would be, the underlying would be a corporate unsecured.
Unsecured.
Yeah.
Okay.
How you doing? Mark.
Nazar.
Yeah.
Hey, welcome. Thank you. My colleague is here.
So, cool. So that's a pointed question because you see this is all the traditional stuff. Anthony's doing it differently. What are the incremental advantages? Because you know all this. So what are the incremental advantages of doing it your way versus the traditional?
Sorry, my mic on. Yeah, come on in.
No, I meant from an investment standpoint. So you talked about being able to dial in your duration. You can't do that here. It has to be matched, right? So your duration and what are the other aspects, because we're not going to explain how you do it, but what are the other aspects that your way has an advantage over the traditional way?
Well, for example, you were talking about the warehousing. We don't need that.
Okay.
We decide to price a portfolio today. This probably takes about a week to get the structure.
Takes 6 months to build a warehouse, by the way, and you need equity. By the way, go ahead.
We can also, as linked, we can also perfectly match our assets and liabilities when it comes to maturities. So if we decide to do a 3-year portfolio, we're going to have 100 credits in that portfolio with each of them with 3-year maturity of 3 years, because it's a synthetic product.
And the last thing is, I think that's different. If I get this right, the counterparties here are the funds that are securitized. Your counterparties are a little different, correct?
Yes. So we structure our portfolios via banks, and there's in today's environment, there's 4 or 5 banks involved. That's JP Morgan, BNP, Citigroup, and Nomura. So we build a portfolio, and they help us put the portfolio together. And our counterparty for the last transaction was JP Morgan. So JP Morgan is our counterparty.
So, but the banks securitize those CLO notes and distribute them.
Yeah.
Okay, that part is there. But the counterparty risk is still back on the CLO manager. In your case, they might sell off risk, but the ultimate counterparty is whom?
Well,
it's the bank, right?
Yeah.
Okay, well, that's not clear here. It's different than this.
Yeah.
If the CLO fails, the bank is off the hook, right?
Yeah,
But that, not with you. Right, okay. That's important. It's important. Okay.
So questions?
Yeah.
On this set of esoteric subjects? Yes.
I might not get these vernaculars right, but our family office is really big into creating their own desk at the moment for medium-term notes.
Can you microphone? I can't quite hear.
Can you hear me now?
A little better, yeah.
Okay. So, anyways, there's a lot of movement that's happening in New York banking, especially. There's a lot of consolidation happening. So I don't know if you guys are seeing the same thing, but a lot of the derivatives and things are kind of moving offshore for a lot of international people. Could you guys give a little more light of what you're seeing? Because we've had to restructure our banking in the last 30 days because of it and the tariffs.
So I'm going to answer this because I'm the bank guy, or I don't think Lang has this, but so the difference is, and what Anthony does and what this does, the bank is a transactional part of this. This is not the bank balance sheet. except for some financing in the
What was that, your
warehouse, which
question?
is very well covered. So the bank balance sheet is not what's.
I think she has a different question.
So if you're a private entity, right? So I'm a family office, right? That has capital, and we have our own desk. Well, I'm talking about settlement, right? So a lot of the services that are happening here
banks
in New
do
York
bank
is no
service.
longer for the last 30 days because of what's going on politically. So I want to see what you guys are seeing too in the market.
So having done this for too long, what we've done in the past, we did with mortgages, change servicers. The portfolio stands by itself. You can
But
change the
where?
servicer.
There's no longer U.S. anymore, so where?
Is anyone else dealing with this issue?
Or have questions that are, you know.
Just particularly this, and how you're settling. Anyone? No one's cross-border? You got one? Nadir?
Ling, do you?
Hold on, let Nadir's got it.
Oh, I'm sorry.
Hold on. Go ahead.
I'm not sure what type of product you're talking about specifically.
Say that again.
Say it again.
Settlement is one aspect, and servicing, securitization is totally different. And so I'm not really sure specifically what you're referring to. But like a CLO note, you buy it, you have a custodian that's going to keep it. You can, JP Morgan, State Street, DB, whatever, they'll be somewhere. You can be somewhere else. You can operate your fund from the Caymans. Who cares? But it seems like you're referring to something else. You've been pushed away from your bank because presumably they didn't want to offer the service you are used to, and don't know what the reason is.
Can you walk over there, or Andrew?
We should pick it up.
Actually, it's a
So
good
all
point.
that business is going out of the United States now. So I didn't know if anybody else was having the same issues.
Question specific to structured credit.
So I think it's sort of how you do banking, or when I'm here. Well, one thing we're going to do, and maybe it's because it's my birthday, I get to call audibles. Last time we were here, I called an audible that we're taking a break. This audible is we're pushing on, because I feel a certain thing. I want to do 2 more panels, and then we're going to do breakouts. We're going to do structured credit and public finance, and fixed income, and one of the breakout rooms where the lunches were. We're going to do real estate where there's coffee. And we're going to stay here on the private credit tracks, and then we're going to get to private equity in a second. So we've got private credit and equity niches next, which is supposed to happen at 3:45 with a 15-minute break, but now we're 5 minutes late. So I'm going to go straight into, we could pick this up, this question even, in the breakout if you could, and those who want to do more, or somewhere, I don't know, like you said, it's sort of a falling through the cracks question.
I just have one statement that might clear it up. Once this is securitized, this is a balance sheet that is away from the bank. The bank could go out of business, it wouldn't make any difference.
Okay.
That's all I said.
All right, so we're pushing on to the credit niches. Nada, if you could put that on the screen. I know Eddie, you're on. Thank you. Rich is on, of course. And Rich, or Ling, thank you for joining. I'll always remember the Galapagos turtles because of you.
Pleasure. Thank you.
See you. I love the Dutch. Dank je wel. Alsjeblieft. 3 of my 5 words. Okay. You're going to switch screens, Ida? Who had the best header goal in all of World Cup history?
RVP.
Yes. Okay. Well, you usually moderate these things, but I have Ilya. Are you on?
Yes, Mark. Hi.
Okay, over to you. Your panel is mostly assembled.
Great. It's a pleasure to get started here. Why don't everyone please introduce themselves? I've done the introduction on the prior panel, but really quickly, I'm dialing in from Monaco. Who's a family of
Nazar, you're on. We're starting
9 years,
early.
allocating predominantly into private credit funds, while also participating in co-investments with those funds with the objective of achieving above market returns while also being senior. With that, why don't we start with Nazar? Just because I had the pleasure of being Nazar's LP and also co-investor in a couple of his deals.
Excellent.
Thanks so much, Ilya. Well, it's a pleasure to be here. I'll do a quick introduction, but just want to thank our hosts for organizing a great group. We enjoy being in front of this audience because, as Ilya mentioned, our firm has a lot of family offices and other kind of non-traditional investors. We focus on infrastructure investing. We do a lot of work with private, kind of lower to middle market companies. We're about 45 people across the U.S. We have a couple of different alternative strategies, but all focused on partnering with private and entrepreneurial-led businesses across industrial infrastructure, energy infrastructure, and all of that. So, pleasure to be here.
Great. Rich, you're next.
Sure. Hey, Rich Wyatt, Rosemar Management. We have 3 verticals. We're private credit, focused investor. We have municipal credit, education-based real estate, and our charter schools. And I lead up our sourcing and origination efforts in sustainable energy, sustainable infrastructure.
Thanks, Andy Vandervaart. I run a single-family office, Polish-American, and have an early-stage climate tech platform. And I'll be sort of basically taking the hat from a family office perspective, how it is to invest, how basically to sort of prosecute private debt in the infrastructure space.
There's John Cox.
You guys?
Started Cox Temple about 5 years ago. It's a secondaries fund which is focused on purchasing non-traded and illiquid products in the secondary market. So it's a traditional secondary strategy, but focused on non-traded BDCs, non-traded REITs, interval funds, high capital feeder funds, that sort of thing. So we access credit indirectly through those routes.
Right. What I love about your approach, sorry, is that it's not just secondaries for like the venture world. It's in this world that we're talking about here today.
Damon Hughes on InfraDX Capital. We focus in on water, wastewater, and wastewater-related energy recovery to development, build, and operate platform. And so basically, think about it as wastewater treatment plants, maybe as small as 5 to 10 million, maybe as big as a couple hundred million. It's not going into inflation, but that's how we hold size.
Great. Just so that we can all have a better grasp of what you do, would each one of you kindly describe your typical deal? What does it look like?
We can like roll
What's
that. So I don't. Yeah, maybe somebody in the middle of the
He wants to go last, I think.
I can start. So we got introduced to this asset class a couple of years ago, and we started to write our first tickets into transition tech. So a couple of our portfolio companies are very much involved in making sort of power to X, renewable natural gas to low carbon gasoline, for example. In order to do that, you need large infrastructure from hundreds of millions to billions. And in order to do that, you need typically some type of bridge financing. And that bridge financing is one of the things that, for example, a couple of the stable offer. And so to name sort of the terms, it's sort of a let's say 18 months to 3 years duration, mid to high teen return on your debt, plus typically some type of warrant coverage upside linked to the performance of the asset that could eventually yield you significantly over 20% IRRs. It obviously depends all on the stage of the technology, stage of completion, what type of collateral, how securitized and collateralized the asset is, etc. But those deals are attractive both from an operator perspective, which you don't dilute that much, as well as from a sort of a holder of the paper. Particularly if you've done your analysis with regards to the underlying complexity.
I can go next. So,
Well, actually, I think you play to that, what he's just, I think you should go last, John. Right? No, because you'll explain. Why don't you go, because you represent what he's just talking about. Damn it.
Sure. Just a couple quick examples, and one we're actively working on right now would be for data center. So large data center, $9 billion. They're focused on water in the site. Literally forgetting about water. No access to water, no plans, and they got to figure it out. So give us a call, help us. What are they get basically a development plan together, and by the way, we can provide some bridge financing to get into the building before it's construction ready. Kind of on the other end of the spectrum, small example, Salesforce down in San Francisco. About a $5 million full water reuse system. It's mandated in the city of San Francisco. You're seeing more and more cities. And so it's kind of the same thing whereby we can, with our partners, kind of design, build, operate, and then we would basically take it off that sheet. And same thing, that would require some bridge financing to get it to that point with the state west.
You make it sound so simple.
It's so not.
Sure. So we focus in on primarily solar and battery storage opportunities in the middle market in the U.S. only. So on the solar side of things, think of a 1 megawatt project is about 5 acres of land. So we're not doing large utility scale, which is, let's say, 100 megawatts and up. We're doing mostly projects that are about 5 megawatts and less, all the way to rooftop. We focus on our deal sizes are usually portfolio oriented, so our sponsors that we're dealing with on the credit side, we're dealing with multiple projects that they're putting out, so they're cross collateralized.
Hey, Rich.
Per sponsor basis.
I forgot your slides.
You know what? That's.
You think?
Yeah, I think that's okay for now.
Okay. Well, carry on. I'll get them up.
Maybe not later. Okay, thanks, Mark.
Actually, yield your time so we get the slides on.
Okay.
All right.
Sure.
Keep going.
Okay, trades, sure. Sounds like some good companies. You know, some of the things that you just mentioned could fit us as well, but think of it a privately owned company, like entrepreneur-led. It might be owned by that entrepreneur or owned by a family or kind of friends and family, if you will, been around for 5 to 10 years. It's operating, it is in the business of investing and owning hard assets. So it could be a large industrial kind of facility, could be a, like we've got small, mid-sized ports, could be water facility, what have you, but it's kind of owned and operated by these entrepreneurs. You know, they're facing a little bit of a crossroads. They really like being independent and really like the business and see a very strong growth path. Maybe they're at 10, 20, 30 million of EBITDA now. They see a path to 100, but because they're in the hard asset business, they need somebody to provide that capital. They kind of bootstrap their way to this, cash flow their way through this, but they now need 50, 100, or 150 million to get to the next level. And the expansion multiple is very, very attractive because they control the whole company and they really value independence. So that we come in, we say, we'll be your capital partner going forward. You can retain full control of the company. You're excellent at operations. We're very good at commercial and other structuring because we're industry people. So we'll not only give you capital, but we'll help you get to that 50 or $100 million EBITDA level. So we've done 43 deals like that. So they all across different hard asset spectrums, but that's the profile.
I got your slides.
Okay, great. Let's talk about.
Sorry, Ilya, I forgot that Rich had a slide. Maybe just give a couple, you talk to a few of them.
The other slide before I could talk
Sure.
about just what we do.
Go ahead.
Yeah, so.
Talking to the mic though.
So power development is similar to real estate development from the standpoint of you're talking about land going to operations at some point in time and construction in the middle. In our sector, there's been really post 2022 banking crisis, SVB going out, they were a big lender in our space. There's a dearth of private or of banking credit, certainly in the middle market. We focus on deal sizes that are anywhere from about $5 to $50 million. So the MUFGs of the world are lending construction in term 50 and above. We fall way below that. We tend to do short duration credits, six months to 3 years, anything from bridge loans on Tesla Megapacks, those are large stationary source batteries, to solar panels, and then we do unitranche construction through operations. Let's see what else. The other thing we're noticing is we're a tweener, so we play between really high, really expensive growth capital and venture capital for developers, and cheaper cost of debt for wind operations. So we fall right in between that area.
I like the elephant in the room. Like wind is like thrown out the window. Solar's still good.
Yeah. So all the energy that was added to the grid last year, 90% was renewables, and we have over 275,000 people working in solar alone in the country. But with the new administration, we're dealing with tariffs. I think certainly that's creating disruption, but the Biden administration doubled tariffs on Chinese panels. Going from 25-ish to 50, Trump's now going to potentially 60. That's manageable, but I think that is the elephant, but the bigger one is what's going to happen with the congressional, with budget. So tax credits are an important part of how projects get financed in renewables. We don't invest in tax credit deals, but it's an important part. And we believe that the Inflation Reduction Act is going to be impacted. That was the 2022 act that extended out investment tax credits and all sorts of other energy incentives. So we see opportunity with that because a lot of developers we're dealing with need bridging solutions during this period of uncertainty over the next 6 to 9 months. And the other thing to note is even without these investment tax credit incentives, solar is still cheaper to build than natural gas. The other thing is because we're dealing with such huge power demand increases with AI,
Which is this slide right here, which goes to your data center.
I'm just seeing things in the energy sector that I haven't seen in 20 plus years. It's really a generational increase in demand. And so if we go down the path of just saying, well, the new administration just wants natural gas or nuclear, the problem with that is there's literally not enough turbines to be built for natural gas plants. New natural gas plants, it's going to be difficult to build them within the next 3 years even. And the vast majority of the queue and the grid is solar and battery storage. So if the investment tax credit gets pulled back, long story short, we still are bullish on solar and battery storage. But there is some uncertainty in our marketplace. So we're focused on shorter duration where we're less impacted, we won't be by ITC movements going to next year, but we're also looking to bridge developers that are going to.
Cool.
Just to pick up on your question a little bit more, so we agree with everything that Rich just said, and we've seen quite a bit in solar. We've also seen quite a bit in wind, but keep in mind that one big difference between wind and solar is solar tends to generate at a time when demand is the highest, and wind tends to generate electricity when the demand is the lowest at night. So that's the practical economic implication, and I think I totally agree with Rich. Solar is right now the cheapest source of electricity you could build in the system. That helps a lot. And even setting the subsidies aside. And then the interesting part about the kind of the trade wars and the tariffs that were passed during Biden and now during Trump is that it creates very interesting opportunities for domestic production of the entire solar value chain. So, we commissioned the first solar cell production facility in Georgia, I think it was last year, and solar panels. But so there's a lot for people in the room. One of the things that that's very interesting is that industry, power generation in general, consumes a lot of capital, and solar is going to consume a lot of capital, and a lot of that is domestic jobs, domestic opportunities. So there's multiple ways to play it. That goes way beyond owning solar or a battery facility. You could be a supplier for that. I think one of our facilities that makes solar panels is sold out for the next 10 years.
Now, John, Microphone.
Yeah. So we buy portfolios from financial advisors. So typically, financial advisors will come to us and say, I have 10 clients in 10 different funds, and they need liquidity across the board. And so the typical deal size is between 3 to 5 million, but the underlying transactions can be as small as 35,000. Just the proliferation of retail alternatives, mostly interval funds, has really drastically reduced the ticket size necessary to get into a fund like BREIT or Starwood, anything like that, the Blackstone credit funds. And so there's really no one playing in that space because the actual ticket sizes, at the end of the day, are so small, even though the portfolio itself is a decent size. So we really can transact across a number of different strategies and structures and dial up the duration or dial it down based on the repurchase programs of the underlying. So there's really just a lot we do structurally to get access to these various asset classes.
Yeah, so Glenn was asking about creativity in real estate. Are you also touching the real estate space and creative secondaries?
Yeah, absolutely. I'd say that almost all of the big real estate interval funds are oversubscribed on the redemption side. And if you're not as familiar with interval funds, they will repurchase about 5% quarterly of NAV. And then once you're above that limit, everyone gets prorated back. And typically, as soon as that happens, everyone freaks out and starts redeeming. And so that's really happened across the retail or real estate interval funds already, and it's starting in the credit funds as well. So.
Back to you, Ilya.
Let's talk about pricing. What does it look like for your fund? Where is it trending? And how does that ultimately eat into your expected returns?
I'll go. Our loan structures, small dollars, maybe they'll cap out at $10 million. So it's small, and we were formerly on Partners Group platform, and making a 25-30% return on a $5-10 million loan was not even a pat on the back because they need big absolute dollar returns. And so our point was, very high returns in this niche, if you will, on the water is extremely attractive, and so the a $50-75 million fund, what we're sizing, can continue to generate those types of returns. Now we're not going to scale to 500 million and start to chase kind of AUM. And the fact is that where we are in the water space, it's niche. There's that's becoming significantly kind of pervasive, but at the same time, there's not very many other folks doing kind of what we're doing. It's just it's small enough to be kind of less attractive, but it's big enough to generate decent returns. And so pricing wise, we're not really kind of seeing any resistance because of the value, and just it's kind of small absolute dollars. So the 20% range and kind of options to get kind of upside returns are all there, but that's kind of what we're taking in.
We can shift to the side. Pricing, an interesting question because it depends on the underlying asset. We do quite a bit of different assets. But let's just say that, to pick up on the example we shared earlier of our deal, that entrepreneur facing the next stage of their business growth, it typically means they can make an equity return, the incremental expansion of their business of 30 plus, sometimes even higher. So, we're competing much more with an equity alternative. So kind of the combination of, do you want to have a majority equity owner of this business who will fund that next stage, plus, as I would like to say, like the price of freedom, that party will control you. So, we definitely price way inside of the equity solution, and ends up being, anywhere between 15 and 20%, I would say, is the all-in pricing. And it really hasn't changed since we've been doing this for the last 15 years. So, and it's all about finding companies that are successful and want to be even more successful. They want to grow, and as Rich mentioned, if they could borrow from the banks at 6, 7, or even 10%, they would do that anyway. Like, we're not trying to compete with that. It's more competing with an equity alternative and the price of freedom. So.
Yeah,
I'd say for us, our pricing is between about plus 700 and plus 1,000 of work. From time to time, we do warrants. Almost all of our credit opportunities are focused on portfolios of projects. We'll get parental guarantees, but we're really normally not doing Holdco loans, corporate loans. It's primarily on hard assets. So solar projects, battery storage projects, or the underlying equipment. Deal sizes are anywhere from call it 3 to 5 million up to 50.
Yeah, so for us, I'm sort of the other side of the medal. What do you get in return? As I mentioned in the beginning, we see these deals for the assets and power to X assets going from mid-teens to high teens on the underlying paper. That is, let's say, bridge financing for 18 months to FID, plus a significant warrant. And again, that's much better than the equity alternative. So in that respect, when you're competing against equity as debt, you're doing something well, because you can get into the low 20s relatively easily with simple conversation. That has to do with control. And folks like much better control with a higher but fair price. Your covenants that are sort of like, no, I'm gonna interfere with your operations rather than a number of normal negative covenants. And so the conversation is relatively straightforward. If you compare that to, let's say, the big sort of core infrastructure debt funds like RTMP or BlackRock, you see lower teams, 10 to 12%, AXA, and so they play also in a portion of the market, let's say more mature renewables technologies like wind and solar. I'm talking about more, let's say, risk-on technologies for which there is significant other covenants. Even interestingly, we talked about this in the beginning of this morning. Sponsor projects. Even up to the point where they ask the sponsors to put a guarantee in, because the asset as a collateral is not sufficient enough. So they have to provide a guarantee, which is attractive as a family office if you can sort of put your balance sheet to work without actually paying in. So it provides very high ROI. So those things, that's sort of a typical business.
So our deals they really depend on what the underlying asset is. It's always priced fundamentally based on where either REITs are trading, BDCs are trading. But a large part of it has to do with the liquidity mechanisms for the underlying fund structures themselves. So for example, on one end, there's funds that don't repurchase at all. They're just going to list on an exchange someday. Those are more aggressively priced against
what is aggressively priced?
We've done deals at 70% off, but it's more around 50 for something like that, for something that's probably 2 years out.
And how do you see the aggressive pricing dynamics today?
They are getting more aggressive as liquidity dries up, as people.
Actually, can I just, as you put a cookie in your mouth, do you want to talk about the secondaries market for a second? Because I don't know if the Stiefel desk is seeing some interesting things. I'll let you take a drink. Phil Donahue would never do this. He's going to take a second drink. Here he goes.
Thank you. So this is not quite a secondary desk, but we have been seeing a lot more active opportunities come back to us, both through NASDAQ private market and through just our contacts and connections and deals that we do, because we're very active on the banking side and also on the distress side too, that there's a lot more coming out. Discounts can be just to the last round. We don't see too many things at 70% off, which would be nice, but we definitely do to get discount to the last round. Sometimes that's 15 to 20% is an average. You see a lot. It depends on who the seller is, sectors, multiples, and the usual mantra around everything else. But the way it is, it's definitely a lot of people are looking not just for the secondaries, also for liquidity for the companies, and also for a lot of times now, if you realize the time period, we've had situations where it's the employees who need liquidity because their stock options are rolling up. So the 10-year time period's up, they need access, they need out because it's too important for them. So the companies actually have to come to market. even though they get no stock themselves. So we're going to see more and more of the employees coming to market, and a bunch of the VC shops have structured themselves as RIAs to be able to buy smaller positions from those employees too.
It's just the sheer volume right now. You got the wind at your back. All right, back to you, Ilya. We're in final stage here, though.
If I may, this could be a very comprehensive question, but was really curious about the marks, your portfolio. How easy is it for potential LPs to understand those? Has anyone used the word esoteric in reference to how you mark your portfolios?
Hopefully not, right?
So ours, the liquidity events for most of these are exchange listings. And so we are marking them, at a discount to whatever the relevant metric is. So if traded BDCs are trading at a 10% discount to NAV, it will hold it at least a 10% discount to NAV. That's a margin for illiquidity. And so that's up from our cost, but down from the eventual exit. So that's something we strike monthly on those products. And it's also nice because when we're reselling those products back at NAV by participating in the repurchase programs, that's well above our marks most of the time.
For us, we have Comresnik. They appraise and value our assets quarterly. They're really one of the largest accounting firms in solar and renewables. So we rely on them on a quarterly basis.
Sounds very esoteric.
Everything we do is illiquid, kind of bilaterally sourced. That's kind of the esoteric part, I guess, about it. The kind of good news for us is we do two things. One is almost all of our investments are in a kind of first lien credit form, so it kind of gives you a pretty good perspective. If the interest gets paid, which is most of our businesses pay interest, then you can kind of mark the loan position at par because it's servicing the debt, and we're kind of the only ones in the cap structure. And then we have warrants or equity kickers upside in every deal as well, and those we tend to try to mark as close to zero as our E&Y auditors will let us, because it's only upside from there and we don't control a lot of the monetization. So when we get close to realization, we'll mark them higher, but until then, it's really kind of a true upside share. So that makes it much simpler when LPs look at it, they say, oh, okay, so it's a credit position, interest gets paid, that's how you accrue your return, and then when we exit, you may get paid out in the equity.
Ilya, final word?
Venom?
Oh, sorry.
I don't think Venom answered this.
Well, it's sort of not fair yet because he doesn't have anything to mark.
Yeah, I think the only thing we'd say is our process is one of control of the development process, and 90% of our funds go to the design of the facility. And so if you think about it, designing a facility, it's a percentage where a contractor can go to basically a full contracted price. And so the more you design, the more you know it's going to cost. And so it kind of feeds that. And so we do it under a stage-gated process. So to the extent we've hit a point where some milestones haven't been met, we stop. And it's either delayed or we can basically recoup the dollars spent. And so that's kind of the risk management, but at the same time, it kind of follows the value as we kind of continue to design the project.
Yeah, Damon, you're sort of an outlier in a good way because you actually do work, not financial work.
Well, look, we started out doing development loans and just handing it off and realizing our partners weren't spending it.
He actually solves it, gets you the permits and the money. But Ilya, we got to move on to the last panel, which is where we make a ton of money, private equity. But you want to?
So I guess my last word would be a way for allocators to generate alpha is to do extra bit of homework to understand niche funds such as the ones we just heard, and it's clearly a worthwhile exercise.
challenge Mark on this. We've had a lot of migration to our funds from people who used to be in private equity. So maybe private equity hasn't made enough money for them.
We've raised 10 times more in private credit. We agree. But theoretically, the private equity guys are going to tell us about the bigger 20, 30, 40. All right, well, thank you guys. So Carl, Julia, and actually Eddie, can I let you? Thank you. Eddie, can you stay where you are? You have to. And you and Olga have to play ping pong at some point. Your forehands, got to go head to head.
I'm looking forward to it.
So Matthew Friedman, are you on?
I'm here.
All right, let me spotlight you. There he is. Because you're a classic. Why don't you should kick us off, because explain the dynamic. Your company's $300 million roughly in revenues. EBITDA, I forget, it's been growing, I know, but you're trying to grow with debt and or equity.
So I'm actually exactly what my colleague from OIC described, and I've actually spoken to his colleagues at OIC. So yes, I am an industrial privately owned company, about $300 million in annual sales. We've got 4 portfolio companies spread across North America, 2 in the US, 1 in Canada, and 1 in Mexico. I would otherwise be eagerly checking in on the speech by the current administration and what's going on with tariffs that's about to kick off right now, but I'm here with you all. And basically, yes, I have an acquisition that I just signed an LOI for. I have some new business launches that are in the works, including one that's in supplying metallic assemblies for the solar panel industry. But primarily right now I'm in the automotive industry, and I'm at about $300 million combined sales, about 10% EBITDA, and looking to get to that $400+ million range in the next couple of years, and in search of some growth, capital, and financing.
Well, how do you think of equity versus private credit? And I know you've tried to use the let's say the traditional banks as much as you can, and
traditional banks have been a big part of it. Equipment financing has been a big part of it. I would say, somewhat agnostic. It's about finding the right partner who has a vision for the future and an appetite for automotive is really the key. I mean, automotive does very well in good times and has certain risks. We're seeing the tariff risks right now. We've seen the risks associated with strikes in the past. I've definitely, had my ups and downs since I entered this business almost 30 years ago, and I'm still standing and, growing along the way. But yeah, it takes certain times. I spend a lot of time talking to people both in these conferences and in the business, and they express an interest, but not everybody really has the vision or the desire to be in manufacturing and in automotive.
well, why should they bite? Why should they share the vision?
Right now, because of all the reasons that have already been discussed, right? With the tariffs that are going on, with some of the transplants that are talking about now increasing their footprint in the U.S. Hyundai announced their plan to invest $20 billion. There's a lot of growth and a lot of opportunity that we're going to see. Something's going to shake out as a result of all of these movements back and forth. And I think entrenched, well-situated, diversified companies like Bear Diversified are in a very advantageous position as long as they have, like we have already put in place, a lot of the capital infrastructure necessary to expand and take on these opportunities.
Okay, I'm going to switch gears. So we'll place marker that Matthew's looking for partners. So I'm thinking maybe Julian and Eddie, and then we'll come back to another situation that could take equity and debt. But Julie, it's been so long. It feels like, was it Chicago? No, you came to New York.
Yeah.
So you've been doing these
You still look fabulous more.
What's that?
You still look fabulous.
You look more fabulous. Feels like a Saturday Night Live skit or something. Well, tell us what's been happening and how you see the world today. What scares and excites you in the growth equity space?
Yeah, no, thank you, and thank you for having me. It's nice to catch up with the community. So my name is Julia Montprinivis. First, can you hear me okay? Okay, great. I'm the founder and the managing partner of a firm called Base Healthcare Capital. We do investments in healthcare technologies, so software, data, AI for healthcare. No medtech, no life sciences. We do what I call early growth, meaning our portfolio has the juice of venture, the resilience of growth equity, and the liquidity and DPI of private equity. And so we really pick our spots. Our Fund 1 is outperforming top decile funds, and we've had our first exits and 0.5 times DPI. So we've really picked our spots in healthcare and brought a lot of discipline in the early stage investing. What gets me excited, what keeps me up at night, well, my sector continues to get me excited, especially in the current environment. One, obviously, we can always find great companies that provide attractive returns, but right now the market dislocation is so acute that it's an ideal time. Healthcare is generally recession-proof. We saw it in 2007 and 8 and 9. Not a blip, not a flickering in healthcare expenses and growth. All the large groups, whether it's hospitals, whether it's pharma, whether it's distributors, are all looking to deploy technologies to first drive revenues, second cut cost, three occasionally drive patient outcomes, but it's really in that order. And today, where can they find value? It's really in technology and in software and how to harness AI agents, for instance, to support nurses in their job and a variety of things. So that gets me excited. The market dislocation and the volatility is creating very interesting opportunities in terms of pricing. So we're very active with deploying capital right now.
So can I ask, you mentioned DPI. We've been talking about credit. Credit, people don't have to think about exits per se. Sometimes their exits are permanent financing on these bridge loans, but how do you see the M&A exit? I mean, a year earlier, but still, just how do you see, because you have some DPI already, so.
Yeah, well, so we've sold actually a company a couple of weeks ago. It was our first investment 4 years ago. And it's again, we find that if you're not trying to build a unicorn and you're not overpaying at entry, which tends to be a flaw venture, but you can really engineer against it, you actually don't need to wait 10 or 12 years to drive a good return. Within 4 years, you can drive a really, really good return. And the market, M&A market, was at a standstill for almost 18 months, right? Interest rates went up, and it became too expensive for strategic buyers of private equity to acquire anything. The math just wasn't working relative to where many of the valuations had been. It brought almost everything to a standstill. But now things are restarting, and we see a lot of people, private equity in particular, with dry powder waiting on the sideline to do a deal. So the momentum is picking up. There was a moment of, as our banker described it, euphoria in the business world, post-election, before inauguration day. Thankfully, that's when we priced the deal. Closing it in the current environment was a challenge, and I say this as the executive chair, so I have more work now. It was hard to land. It is very chaotic out there. The constant negative news cycle creates fear, and so while the business community, and I'm here not making any political statements, but the business community was looking at the Trump administration as being potentially a golden age with less regulation, increase in tax cuts, and potentially just more space to operate. And I think there is a bit of coming back from that just because of the news cycle, the tariffs as well, etc. So the M&A market is probably not going to be as strong this year as what everybody had hoped, but there are pockets of opportunities.
Okay, so Eddie, you wear lots of hats. One of the hats is you're like an LP in her fund.
Yep. And it's I don't have to
have to use the mic.
Twice.
Microphone.
I don't think twice about complimenting Julia. Not only did she do very well with our investments into her portfolio companies, she seeded one of my best friends who is now, a triple-digit million company, and she just exited her first portfolio, and she does that while looking fabulous, which is nice, but also having a
Well, she's
team
French,
of great diversity. And is in a marketplace where you don't realize it's not the epicenter. Right? She's in Chicago, which is not Boston or not Silicon Valley. As a result of that, she picks up these sort of, you call it esoteric, but I usually get it in a positive way, esoteric opportunities that other people don't see because they're not there. Like Silicon Valley boys fly over Ohio, right? Similar in healthcare. And so that allowed us to be very comfortable with sort of financing her projects. Also, she's incredibly thoughtful, and that's one of the best decks and analysis.
Okay, this is turning into an infomercial for Pace Healthcare.
Too much information, but it's very, very good. So that's, it's a little bit about that goes to selecting managers. You feel comfortable with because they do their job. They have a specific angle, specific thesis that they relentlessly focus on. And today she marches to the same drum as 5 years ago, which is nice, consistency, and the results show.
But more broad, but more broadly than Julia's fund and the private equity. You talk about private credit. How do you think your family? If you go to Markowitz with you have 5 deals and he's looking at you show him a private equity deal versus a private credit deal. Like what kind of return structure? What do you have to do to get the yes?
Yeah, it's obviously very different, right? We look for a very different thought process around private equity. Very different thought. By the way, Julia is sort of in between venture private equity, I would say, more growth equity.
And to be fair, it was 4 years ago, which was a thriving venture market too, which was like, we got to go into this.
Yeah, exactly. So the thought process is very different. The equity returns, frankly, because the returns on private debt right now for us in our family office are high teens, low 20s. That's the marker for private debt. The market for private equity, because of the risk return, is significantly higher. So it'll be 25 plus on and on specific projects, probably more than 30. Otherwise, principals say, well, you can get this with collateralized.
Well, let me ask you then back to Matthew. Like let's just say theoretically, you wanted to give him, he wants 10, 15, 20 million dollars, and you would probably, I'm guessing your answer, you would probably do a structured equity, structured debt deal so that he gets what he wants and you get what you want.
Yeah, probably layered to 2 different ways. I layer some portion of it as sort of private credit.
I'm trying to structure this for you, Matthew.
And have significant collateral.
I have spoken.
I believe there's lots of upside in this particular climate for him, particularly because his competitors are not so well situated versus him in terms of tariffs, right? He has a very low percentage of Mexico and Canada versus a lot of other people higher. That's a separate conversation.
Sure.
So a tranche of debt that where you have significant collateral, the entire as much you can get, and then the rest is sort of equity, which sort of, I would say, operates as equity, but can also convert and is preferred.
Yep. I guess that takes us to you, Carl. You're trying to figure out your equity debt stack, and you might want to just remind people who weren't here this morning what it is you do to help the world and make a lot of money.
Yeah, what I have is a company. We take end-of-life tires. There's one for every one of you out there every year, and we recycle those back to the base chemicals of carbon black, and then the liquids we convert back into limonene, which is your lemony fresh cleaning smell, jet fuel, and a viscosity modifier. And we're pleasantly involved with 4 projects here in the States that we own between 25% on each one of them. They're all about, the most expensive one is $245 million. The other one is, say, 200. But they all will roll about $100 million worth of profit each year, and they're up in 18 months.
So how do you look at the capital stack? You're mainly looking, I mean, you got offtake agreements, right, on the under major revenue flows. This is proven, it's not a new kind of technology or plant.
Correct. We have offtakes on all of our products coming out. We have insurance on plant performance and construction schedule from Munich Re. So they're covering us there. We have back-to-backs with everybody else. So from a cash standpoint and risk standpoint, I'm an old risk management guy from Westinghouse. I used to do their nuclear plants. So we sort of covered ourselves there. And now with each one, there's a major international equity investor on all 4 of the plants to the tune of about $1.2 billion. So, but he's taking a nice piece of chunk of the money, but he's not charging interest, which is good.
Maybe
we've basically structured ourselves.
I think the opportunity for this crowd is, I think, more to be in your holdco. We can get into. He's got 12 plants he could do. Each one could, create about 60 million of EBITDA. There's a rev share with the partners that do those plants, or $250 million plants. But the holdco investment now gets us into, it advances all the projects, right? Gets them entitled, gets them moving, some R&D on the technology.
So what in the base case are you offering, Carl?
Okay. Well, basically, an holding company, which is where our piece of the action of all the SPVs are, is where we own all the plants at that area. We license those plants at $1 million a pop. There's a recurring license on those. We get 8% royalties on all the products that come out of there. Plus, on our construction cost of actually building them, we're at a 30% income before taxes. And we're basically looking for somebody to help us break away from the parent, the big investor, to invest in the holding company, because we'd like to expand our business out and go worldwide, in which case then we need to staff up with some engineering people and some marketing support.
So, but Eddie, maybe we don't go into the. It's getting closer to a securities discussion, but just the principles of it, and how you look at the.
Turn off the camera.
But no, FINRA still lives with the camera off or on. But just but talking about the equity the markets, I do think there's an equity opportunity in the holdco. Obviously, you should be able to build debt on the stack that you have with those offtakes. You're still going to need pref or other kinds of equity, but I think that's probably from a strategic that really gets it. And I think the family office opportunity is more in that holdco, is my guess.
Yeah, so we're basically looking to for about $20 million, we're looking to slide off 25% of the holdco.
Well, thanks for answering that question, Freddie. All right. So I just wanted to get the private equity landscape about how do you all see it from your purchase, what you're looking for returns wise, and other questions comments you may have. And then we will have 4 breakouts. Private credit will be here. We'll have a real estate. We'll have the public fixed income and structured products in both those breakouts, and then I think private equity will be with me in this room somewhere. Questions? Oh, look who's here, James. Elvis is you looked more like Elvis before, but yeah. So questions, comments? The pregnant pause. I'll call on you. First of all, you lead the private equity and the M&A. Margaret, come up here. And look. So introduce yourself, and then maybe how you see this private equity marketplace today. She leads the practice here at Baker Hostetler.
Well, Thank you so much. Hi, I'm Margaret Butler. I'm the head of the financial services industry team here at Baker Hostetler, which is the largest U.S.-only full-service law firm, right? So we have 50 state coverage. We can solve your legal problems anywhere here in the U.S. And of course, we partner with best-in-class people everywhere else. I tend to be provocative, and so why don't I say something provocative, right?
I like that. A lawyer's going to say something provocative.
I'm too provocative for a lawyer. No, so as you mentioned, we had 2 years of essentially no M&A activity, and some of that may be owing to the interest rate environment. Is there a possibility that some of it is owing to the fact that private equity has squeezed out the value in the existing business model, right? And we've sold things, we've sold them again to other private equity firms, we've marked them, and now really we need to see some more creative strategies to realize value.
Great question. It's possible. It's possible, and I think the value creation aspect is not uncorrelated to the low interest rate environment, because in an environment where money was virtually free, there was just an incentive. If you look at, so my previous job before starting my own firm was to lead private equity for healthcare for a sovereign wealth fund called CDPQ, Caisse de dépôt et placement Québec, 400 billions of assets under management. And it's a young province, so they didn't need the capital to support retirees. And when you were asking the constituents, what do you want? Do you want stability? Do you want credit? Do you want more return? The answer was always hands down more returns. Just build the capital for the long term. And what that meant, looking at the portfolio, was doubling the allocation towards private equity. And when the CAT does that, it's $30 billion that moves, right? It's a large amount of money. What that means is, okay, where do you put it in private equity? Well, there are funds, and funds grew bigger, right? Blackstones and KKRs, they all grew bigger funds. They could therefore afford to pay a little more, which created a vacuum effect to pick up more and more assets at higher prices. It's also called inflation, right? It became just more and more expensive to buy the same thing. Then others went to start deploying in direct, which was sort of my job. Find new things that don't exist, create new deals, and we were very creative at doing that. But it is also true that we had almost a decade of bull market in valuations. So once you've done a number of things, then what do you do next? And I do think there was a next chapter. There was a next chapter around technology. We're still in the early stages of seeing truly how software, AI transform old economy businesses. That sort of stopped with M&A crashing, which I attribute to interest rates going up, but I'm hoping that this drives the next decade of value creation, and that it also forces more discipline on managers and in PE to actually drive value creation. But it was a great question.
Anyone else?
I have a question for you.
Sure.
Just feel free to correct me, because I'm not a private equity guy. So, observation is that, go back, private equity went in with some equity, bought a company with some equity and a pile of debt. Company made money, paid down the debt, now you own all the company. Okay, fine. Private equity sells, you get paid, all good. Seems to me at some point the game changed, where now you buy a company with a little bit of equity, you put a lot of debt on it, you pay yourself first, and then you see what happens later. I mean, I'm being a little facetious, but you tell me.
No, that's real. But I mean, I've been seeing that for a long time. It may be that people have finally caught on. As am I. Dividend recaps are not new, right? And that was the first thing you did. You tried to take your money out as quickly as possible, and we try to protect in the documents, right, so that investors are not taken advantage of in that way. But definitely, if those protections are not very carefully put in place, that has and continues to happen.
and how much of a problem now versus the past do you think that is, or is it not much of a problem?
Oh, I think it's a real problem. Again, I'm going to be provocative here, folks. So
That's my question.
There are two problems that come up against each other, right? And I think the problem that you try to solve in groups like this, to some extent, is how do we make sure that fund managers do not disproportionately benefit, as opposed to their investors, right? And so that's one problem. And the other problem that you weigh against that problem, I think we would all agree on this, is, well, how do we make sure we have enough expertise in our deals so that we all make money, right? And I think those two problems are constantly in tension with each other. And so you need to reward the people with expertise to manage the funds, to grow the pie for everybody, and you need protections when you're in an LP capacity or in a co-investment capacity to make sure that you also participate in that growth. And yes, the answer is lawyers. We actually know how to do this. We do.
Oh, boy.
We know how to protect in the documents.
Eddie's going to be provocative, I think.
I'm not provocative, but a lot of you guys may have missed the session we had this morning with a lot of family offices there, where the gentleman who was presenting, Bill Deukler, was sort of like the eminence grise of the family offices almost.
Mm-hmm.
He proposed a model, sort of an allocation model that provided for 25% private debt. And it has partly to do with the asset class private equity being really disappointing. And going forward, the asset class sort of public equity is also not likely to outperform. And that was sort of well met. That wasn't sort of, oh, that's so strange to have this sort of relatively new 1.7 trillion asset class being 25% of your portfolio. That was sort of like,
Of course.
yeah, that makes total sense. We've had, this is obviously today, we talk a lot about debt in various forms, but I feel that asset class is sort of setting the bar higher for private equity. And I do work with a number of family offices that actually have that as sort of the lower mark on their private equity sort of expected returns, which is high teens, low 20s. And if we don't see an easy path to get that, then it's a no-go, because fundamentally it's the private credit is less vol and less risky.
Can I say something? Because this I have seen, and it's actually become a problem in deal making, because now everybody just wants to lend, right? Now that's what everybody's fixated on, and they want to go into the capital stack as debt, not as equity. Capital markets don't work that way, right? Like this is developed over time. There needs to be equity in deals, and it should be the residual value, and it should have the disproportionate share of the return because it's taking the disproportionate share of the risk. So I do think there's a recalibration, but the precise point you're making is one that I'm seeing affecting deal flow right now because there's just not alignment on it, for what that's worth. I can stop being provocative, Mark.
No, you're now moderating. Keep it going. Other questions, comments?
Can I poll the audience for a second?
Sure.
Who is interested in, especially given your comment on private credit, which I think is spot on, how many this year are looking to deploy capital in private equity or those private asset classes?
Private equity and debt, or just private equity?
Private equity and through venturing.
Do you mean like a fund?
Yes, or deals.
Right.
Like a buyout?
Right.
Buyout,
Would never
growth
do-
equity or venture.
Who cares?
versus
Let's just
debt
move on.
versus-
That's okay.
No, it's a
Let's-
good question. I'm trying to see who is interested in
It's the
equity
asset,
risk.
the asset class,
Yes, relative to debt.
whatever form.
So, yes,
Yes.
we've done a buyout.
So a third of the room, which I think is interesting, because if you asked that question 3-4 years ago, it would have been,
3/4 maybe.
yes, exactly. It's an interesting change in temperature.
I agree.
Well, we had a question earlier today about returns, and I guess we talked about that. Those who would be happy with 7 to 11, those 11 to 19, and the 7 to 11 won.
%?
Yeah, the 7 to 11 beat out the 11 to 19 for your overall portfolio. You'd be happy with 7 to 11.
Yeah, overall portfolio, right? Not just.
Right.
It's,
Yeah, think that's what they deliver. I deliver. I don't have.
But I know there's some people in this room that won't get out of bed for 30, 40, unless they get 30, 40%.
But it's also return relative to risk, right?
Right.
And is it
course.
also actual returns? Because especially in equity asset classes, there's a lot of, I wouldn't say necessarily gaming, it assumes ill intent, but there are practices on marks that can lead to misunderstanding on what the actual value is on the back end. And so it's interesting to see how in the last 5 years there's been so back to the basic, back to the fundamentals. That was, I think, necessary. There was certainly a lot of market in the market.
Plus, we have a new dynamic. The secondary markets are much more voluminous, and they're creating the marks. You can't argue with those marks. Other provocative questions or comments?
I got one.
Yes.
So if we're in this world where everything's about debt and you can get 18 to 20 returns, how do we get back to equity returns kind of getting normalized where you do want to put equity into deals and we start seeing more deal flow? Does that make sense? Like if you're just getting great returns on debt, why do equity? Why invest in new companies? Why grow other companies if all your returns are good enough? What's going to change? What has to change for those returns to go down in debt?
I'm happy to talk and then feel free to chime in. One is, I do think that equity should continue to yield above 25% on a net basis, right? This is the appropriate reward for the risk. It's not the IRR you see these days because there is compression in the market and pricings were very high and M&A was done at high prices in 2020, 2021, 2022. It's now normalizing, which is compressing returns, but generally the reward should still be, and what a manager works for is still that target. There is an assumption on mezzanine or private credit that it may yield 18 to 20%. I think this is what's priced currently. We still haven't seen necessarily defaults, so it needs to survive the recession, which depending on what data you look at, and maybe this was covered today, is somewhat already here. So it doesn't price default in it, and I think we'll see real returns way lower than that in the private credit portfolios. AD maybe.
Yeah, I
you
think
know very well.
it's a maturing industry, so over time, when you double from 1.7 to 3.5, you will see rates compressing significantly. That's sort of the 18 to 20 is a higher end of the return. There's tons of debt that does 8 to 12. So I think that's the average is probably significantly lower than sort of what we mark for, but we also incorporate significant amount of risk with acceptance of some default too, right? So it's not there's no panacea here. There's no sort of magic wand that say, oh, don't do equity. I don't think that exists in the long run, at least. Short run, sure, there's probably a couple more years there if you choose well. But that's an interesting thing. We had this conversation about the private equity managers. You see a massive spread in between the 25th percentile and the 75th percentile returns, more than 10 points, I think, in the discussion this morning. So it's the headline is misleading. You also have to pick right. Not only let's put some money into private equity. Well, if you don't pick the right manager, it may be 8%. And so conversely, when you are lucky enough that you have the relationship and pick the right manager, you can do top quartile results, which still net you upwards of 35% today. Okay. But I think both those rates will compress. Mostly the private credit will compress to probably lower teens. And then there's reasons for private equity fundamentally should be rewarded 25%-ish, I think.
So
Eddie, would you say that credit defaults are correlated with private equity bankruptcies as well? Is it the circumstances?
Yeah, I understand.
Somebody says recession.
So one
generalization.
So one thing we're seeing just related to that is as private debt got hotter and hotter, right? They accepted terms that were less and less protective. right? So from what a lawyer would like to see, they started lending with fewer protections. So yes, so we can expect, manager selection to have been very important, right? And people who didn't take undue risks will perform better.
Credit is recovery.
Credit.
Recovery
Credit.
process.
What, right, for the
Some
recovery
don't have
process,
it.
right,
And some are really good at it.
right.
Yeah, we're doing a roundtable about equity.
Interesting point, it's a side point, but
We'll be in this room.
on the infrastructure credit, recovery rates are very high. I thought that's a sort of I didn't know it until I looked into it. The 5-year recovery rate is 97.4% or something versus an industry average of 92%. Massive difference if you look at it in terms of returns. And hence, that's why we gravitate towards looking into and heavily investing in this, because recovery rates are very important. Time for the breakouts, Mark.
I'm feeling it. I'm feeling breakout. So let's explain how we do breakout. This is the 360 and 361 firm, and it started because of my frustration. I don't know why. Because I come back and I had these, I went to an alumni event and it was just random. And I got lucky to meet somebody or I didn't. So what you want to do, so we've got 3 rooms here. We got a room, well, I'll call it the coffee room where people are having coffee. Then we have the lunch room where the box lunches were. Then we have this room. So these are the 3 rooms we've got. And the way it works, whatever you choose, there'll be real estate in one, again, public fixed income, structured credit in the other, and here will be along this side, and we'll have to maybe rejig the tables a bit. I think we'll do it sort of cluster here. We'll have a roundish table, private credit. Over there will be equity players. They might merge at some point. Food is being brought in, as you can see, so we can grab a drink, grab a bite. But when you get into this room, I need leaders, call them co-leaders, to make sure that no one riffs and talks too much, right? Okay, because it's all about getting to know who's in your room very quickly, your name, your firm, and let's say one sentence, not a run-on sentence, but just what you do and one sentence. That establishes that should be very quick, and everyone knows who's there. Then I'll be walking around. Then we'll basically try to talk about the perspective of what you heard today, and then toward the end of that discussion we'll have takeaways. Takeaways would be, should we have a real estate event? Should we have a public, fixed income or structured credit event? That's all we talk about, instead of having a half an hour. And every Tuesday and Wednesday, we can have such an event. So every Tuesday at 11 o'clock, we have our briefing. Where's Stephen? Of course where's Stephen Burke?
His computer's right there.
I can't believe he walked away. Anyway, he's always here, except for the moment that I need him. And then right after that, at 11:30, we did health tech last week. We can do a deep dive on any of these topics. So I just need somebody. I need 3 people to be on a panel. That's all. And then it's kicked off. We put it on the schedule. So that's one of the takeaways. Or it could be a summit. This is a private credit summit that came out of the same discussion. So again, you can sort of stretch, take 5-10 minutes, come back in this room. If you want to be in private credit, we'll establish this side. Private equity, venture, any equity will be on that side. Real estate is the coffee room, the esoteric structured credit, and fixed income will be in the lunchroom. And I'll make sure that I need somebody that is in control of having everybody to introduce themselves, and so this doesn't become that, right? No sidebar conversations. That's rude and inefficient. Well, you can do it now. Okay, you got that? And then when we're all done, we debrief on what the takeaways were from those sessions, those breakouts. And then we all go to Avra, I think, or something. I don't know. Wherever Depender thinks we should go. He rules over there, across the street.
All right. Mark, I am logging off. I gotta go.
All right.
To the elimination.
Yeah. Tell us what happens with the administration positions. Good to see you. I'll tell everybody about my birthday trick on you later. Bye.
$3,000 of puts right now. Market just dropped almost 63% tariffs on Thailand. 40% on China. Stepping down in a few months, as I said.
Equity will be on that side.